Rallying cry, Ursula von der Leyen says, well, calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So let's take a look at the futures. Despite all of the concern out there in the markets, and we have a pretty scathing review also of what could happen to UK stocks from now on, we have a number of reports actually looking at UK stocks and bonds, and none of them, I have to tell you, are very encouraging or positive. European stock futures gaining some 0.6%, so it does look like we're opening a little bit higher. The bullish sentiment, I guess, weakening the dollar after its biggest jump in a week yesterday, and so that's also potentially giving a bit of a lift, so watch out for currencies, watch out for commodities. I think without a doubt, the biggest story of the day is what's happening with OPEC. Arman is currently on the ground in Vienna with some great exclusive interviews. He was actually the first one to speak to the Russian energy minister. Brent crude, you can see 93.12, so watch out for any kind of impact this has also in terms of spat between Russia and, of course, OPEC and the U.S. The CAC 40 opening up. So we're seeing some of these markets and these equity indices opening. The FTSE pretty much unchanged, but we are seeing gains for the CAC 40 and the IBEX over in Spain. So cross-asset, the one thing we always watch out for, and you know it, you know what it's like, is basically what we're seeing with the U.S. 10-year yield, 3.77. The action, of course, overall in the markets yesterday appeared to rethink on the impact of the decision by OPEC to reduce daily production by 2 million barrels. I'm a little bit surprised at what the markets are doing now, because of course the question is, if you reduce by this much, what does OPEC know that economists don't? Now, oil prices trading higher this morning after an action-packed 24 hours. OPEC Plus agreed to cut its output by the most in 2 years, earning a rebuke from the White House. Well, the U.S. National Economic Council Director Brian Deese says President Biden is disappointed by the short-sighted decision.
Well, we were disappointed that OPEC made this decision. As the president mentioned, we think it's unnecessary if you look at the global environment where supply continues to be the predominant challenge. We've been working for some time to take action and encourage action globally to make sure that supply actually matches demand.
And the EU approved new sanctions on Russian oil, drawing a veiled threat from Russia. Now let's head to Vienna, where Bloomberg's Manus Krani is standing by. Manus, let's start with the rallying prices. I mean, you had some market-moving interviews yesterday. What are traders looking at today?
They're more worried about more cuts to come. It's the 3 C's: caps, cuts, and conflict. I'll come to the conflict in just a moment. To quote one of the great American quotes from the time of war, of the Iraq War, you know, the known unknowns and the unknown unknowns. And of course, we're going into this vortex of the unknown, which are what will the impact of these price caps have on production and prices and volatility. For the Russians, it's going to mean a reduction, a near-term reduction in production. That was the red headline from Novak, the first sit-down with the Deputy Prime Minister, exclusive to Bloomberg. And then the Saudis are worried about the volatility. But let's tune in to Novak and his salutary warning to the West as he arrived in the heart of Europe.
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good, is that this mechanism is unacceptable to Russia. And if it is implemented, we are not going to supply countries which join this mechanism.
Get ready for volatility. Production drops from Russia. Who's going to fill that gap? The Saudis, His Royal Highness Prince Abdulaziz bin Salman, wouldn't be drawn in terms of his readiness to fill any customer needs that could come from a drop in Russian production. But why cut now? They're painting in this building in the bunker last night, Francine, that you know so well. They painted graphs and imagery, Bloomberg graphs, in terms of the drop in demand, the fragility of demand, the fragility of the situation. But the bottom line is, all that political capital, the fisty bump moment that you saw Biden and Mohammed bin Salman have, that political capital that Biden spent. NOPEC is back on the table. That could have the Saudis ouching like hell. And an SPR. You want to cut barrels off the barrel? I'll see you and raise you, because I've got a lot of oil in the bunker in the SPR, and I will release it. Those are the messages coming from the United States of America. Fran, Tom.
Yeah, it does feel like it's just so much more political. There's also a great piece by Javier Blas looking at the, of course, interlinks between some of the decision and what it does also to the coffers in Russia. So Saudi's top oil official saying that U.S.-led plans for a price cap on Russian oil only added to the uncertainty, Manus.
Indeed, and that uncertainty is what's irking everybody. How it's going to play out, where it's going to play out. Let's listen to His Royal Highness Prince Abdulaziz bin Salman.
Lack of details and lack of clarity, and the lack of the fact that we still have 2 months to go for that these two things to be activated. These 2 months will be a period of uncertainty. We don't see what will be the reaction of the market, of the participant.
He again reaffirmed his message that the markets were fragile and illiquid. I pushed him, is this a series of jumbo cuts to come? Are you ready to do that? He pushed back against that. In the macro discussion, and go and listen to the whole interview, because it is worth it. Shameless plug, why not? But it is about the central banks around the world are prepared to chase inflation taming at any cost to growth. But of course, I put it back to him and I said, you know, you're stoking, refueling the inflation fire. The Central Bank of Oil took action yesterday. The question is whether it's a one and done or one of many multiples to come. Tom, Francine.
Manus, thank you so much. I have to say, I'll do a shameless plug for you. It was a fantastic interview. I am unclear what the market is looking at, because either they just think the world economy is going to be much worse than expected, or they're trying to give Russia a helping hand, and that has a whole lot of geopolitical, of course, implications. Manus Cranny, they're on the ground for us with, of course, all of those exclusive interviews, and he'll have plenty more throughout the day. Now let's bring in Bloomberg's Christina Kino and Neil O'Sullivan, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. So thank you both for joining us. Christine, I'm looking at oil and I'm thinking like, okay, the oil markets and traders are pretty cool about this. I mean, should we look at it as a geopolitical standoff instead of a imminent recession, red flash warnings?
Well, Francine, it does seem like a geopolitical standoff at the face of it. What I'm particularly worried about is the implications for inflation longer term. I mean, the reason probably that the Americans in particular were very incensed about this, there's of course the political aspect of it, as Manus was alluding to, but then there's also the economic monetary policy aspect of it. This is not going to be a good thing. Higher oil prices heading into the winter time. I mean, the U.S., the Fed officials have been just repeatedly hiking those rates and really trying to get a lid on energy prices specifically, but also inflation more broadly. This is not going to be good news. It's not going to be good news for the midterm election season in November. And so all around, it just spells quite a negative picture for inflation in the U.S., but also globally.
And yet markets are up, which is a conundrum, right? Because it's true, it filters through inflation, it exacerbates the standoff, or they see something ugly happening in oil demand.
And it's probably part of a broader, bigger theme of deglobalization, where frictions are coming back. Allies who used to work together are becoming a little bit more contretemps. I think two things to maybe why the market is a little bit more sanguine about it. It's obviously a 2 million cut, but when you look at the numbers, there were already one under that. So it's probably a net effect of only one by the time you look at it. And secondly, if you go back to earlier on in the year, When you had the situation where the sanctions were coming in, people assumed there was going to be much greater shortage of oil. Unlike gas, which is piped, oil is shipped, and it's made its way through the world into lots of other places. And so the worst effects of that did not happen as expected. So I think markets are still probably watching this to a little extent. However, continuing to have inflation protection in your portfolio is clearly something you need to do.
Yeah, so how do you do that? But Neil, first of all, I also have a morning must read, and today I have to say it was fantastic. It came out late last night by Javier Blas, one of the most brilliant opinion piece writers, especially when it comes to oil, and he says, you know, this is a direct snub to Western governments. So given all the implications, how do you protect your portfolio?
So I think when you look at your portfolio and look at what's going on, there's a lot of things on the commodity side that could happen. The other thing we're not talking about, but the other reason there's been probably a pullback in commodities recently has been in China economic activity has been a lot lower than expected. You could look into post the party conference and see a lot of things potentially open up, particularly if something like the zero COVID policies were to be relaxed a little bit, and that could be a real bull case. So having exposure to commodities in your portfolio is clearly something that you should probably have strategically. And also, there's some tactical elements to it as well. Because of those markets at the moment, the roll yield is really, really interesting in commodities. The cost of the spot commodities relative to future commodities, it pays you to effectively take that curve on an ongoing basis. So putting that into a portfolio is a very interesting thing.
Yeah, and then, of course, it goes back to dollar, king dollar. But took a bit of a breather yesterday.
Absolutely, Francine. It's still kind of very interesting, really, the dynamics of the dollar and everything that's feeding into it this year. I mean, I think there's a little bit of this view that perhaps the peak is behind us, but I'm a little skeptical of that just because of what we keep hearing from the Federal Reserve officials, right? I mean, this week, they've very much pushed back against this idea of a pivot, which buoyed markets initially at the start of this week until we heard from the officials saying, no, hang on, we're going to keep doing this for a little while longer, and that peak rate, we're not even close to it yet. And so, you know, if they're going to be, that's the path of policy moving forward, and they're outdoing everyone else, it's really difficult to see the dollar pulling back on a sustained manner. I think it might be a while before we get to that peak that a lot of people are hoping for.
Yeah, and so we'll talk about, of course, the Fed in just a second. We'll also hear from Mary Daly and Raphael Bostic. What I'm surprised about is that the market wants to believe so bad that they're done with hikes or that they will take care of the economy that they just keep on trying to price it in. And then you have official after official, you know, that just come on and say, like, guys, we're fighting inflation. We're fighting inflation. This is the one thing, the one job that we want to do right now.
So one of the things that's really interesting, we talk about the Fed, after the GFC, there was a long period where the dot, the forward dot, the one way out in the future, stayed at 4% for a really long time, and nobody kind of believed it. Now that dot is sitting at 2.5%, which is, the Fed is telling you, no, we're moving it up here, but the market don't want to go there. So I think there's clearly a desire for people to see peak Fed. Now, what I will say is that when you look at what's going on, I think people have talked about the new normal for a long time. We're probably back to an old normal situation with real rates. The Fed is now data-driven. They used to give you forward guidance, they won't anymore. They have, the market is expecting what it's expecting, but the Fed will react to data.
I don't want to push back too much because you're absolutely right, but if there's this belief or this longing in the markets, even by just looking at the current data, they have to be aggressive if they're going to go from the inflation number now to 2%. Why is that not being priced in?
Well, I think if you look at the hikes there's in, you have 75 and 50 built in.
Yeah.
They are going to keep an eye on what is happening thereafter. And if you start to get to a recession, if you still start to see things slowing down, my personal view is what they're really focused on is the inflation expectations. That will drive everything. And it's only when they see that that is very, very anchored and they see real evidence of things falling off that they will start to cut. So I would agree with you. We remain in our portfolios positioned that things that will be doing well should financial conditions continue to tighten will be rewarded in portfolios.
Yeah, would you go as far as saying, Christina, just markets are too optimistic about their own future?
At this point, Francine, yes, I would think so. I mean, again, you're absolutely right. This is kind of the price action that we saw this week is really that kind of hope. I mean, it's almost like it's hopium that the Fed is going to be stopping its policy hiking cycle soon, but we're really just maybe halfway through it at best. And we've seen this before, right? I mean, over the summer, the narrative was peak inflation, which was very quickly shattered when we saw successive CPI prints that that really exceeded expectations. I think we're in danger of kind of falling into that same trap again this week, especially ahead of those non-farm payroll numbers tomorrow. I think if that affirms the Fed narrative that they're going to keep moving forward, then markets have to recalibrate their expectations.
All right, thank you both. We have plenty more, of course, on the Fed. Bloomberg's Christina Kino, and staying with us, Niall O'Sullivan, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Coming up, more Fed speakers pour cold water on hopes of an early dovish pivot, so we continue that markets conversation next. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
Well, those are some FOMC members, Mary Daly, Raphael Bostic, echoing that the Fed is unlikely to cut rates next year. We're back at Talking Markets with Niall O'Sullivan, the Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Now, I think I'm pronouncing it right. Do I get full marks for that? This was like my only stress today, apart from looking at treasuries and trying not to get the market expectations wrong on that. What needs to be repriced, like now, not tomorrow? Is it treasury or equities?
I think, as I said earlier, I think the Fed is becoming increasingly data-driven, so it's very hard to look out forward. They're giving you a very clear steer, and they want the market reined in. I think the Fed would like to tighten financial conditions generally. The Fed rate is only a very small part of that. When you look at the financial conditions, equity markets and the 10-year rate are equally as important. There is no doubt that the Fed is not in favor of financial market conditions loosening and is doing its best to reassess that from Jackson Hole all the way through to now. And I think when you look at that, you certainly would be concerned that the equity markets, particularly in the US, have probably retrenched a long way.
Yeah.
And so therefore, the fear would be that this will be another of the bear market rallies that we've seen along the run.
I know in your conviction call, so you have, for example, short duration opportunities in credit and high yield. Is that G7 countries?
I think, well, in particular, what you're looking for is one of the big themes we're going for is favor the fittest.
Right.
So this is going to be a tougher market. So in particular, in that context, just return for equities for a second, I would be very much focusing on low volatility, higher quality, stuff that is already marked down. On the fixed income side, I think in particular, when you look at some pockets in the US and elsewhere, you have over the next number of years, a recession should it come, not likely to be very, very aggressive. But pricing built into credit spreads would be much more in line with a very much steeper recession. So particularly on a 2-year, 3-year view in investment-grade credit and high yield, you could see that those assets will be money good in the end. It could be a bumpy ride from here to there, though.
Okay, what's a bumpy ride? Like actual pain both ways?
I think you will see falls in value along the way, because if there becomes growth fears, then every high yield asset will reprice. But I think they will ultimately end up money good over that period because of the protection that has been. There will, of course, be defaults, but the spread will be greater than the defaults will realise, we believe.
When you look at the government chaos here in the UK with the U-turns and the pretty chaotic Conservative Party conference, is the UK investable?
I think the UK faces some real problems, particularly when you are reliant on the kindness of strangers, when you're running a budget deficit, a twin deficit. So you need to have the confidence that is there. I think what you've seen over the last few days and weeks with effectively the OBR coming back on the picture, though nobody's 100% sure when, with the movement of tax cut, is evidence that they're trying to be a little bit more market aware and market savvy. But I think you also have some key dates coming up over the next while when the Bank of England removes its support and the LDI market needs to go back in and function. The one thing I will say there, though, not since Mario Draghi has a central banker achieved so much with so little being spent. To date, the Bank of England has only spent about 3 billion of the promised 65, and it has managed to stabilise and normalise those markets.
Yeah, but in 10 days, effectively, there's no, last buyer or buyer of last resort.
There's no stated last buyer of resort, but the market has learned a lesson. And I think, generally speaking, one of the other lessons I think that is out there is the central bank put that has been there for a while is probably still there should there be financial stability threats like we saw in the UK or indeed elsewhere. Not necessarily much used for equity markets, but very useful for credit markets.
Now, thank you so much, Niall O'Sullivan, there, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Now, coming up, £300 billion, that's been the hit to UK markets, both, I think, bonds and markets and equities since Liz Truss took over. Has the nation become uninvestable? More on the PM's wild first month. That's coming up next, and this is Bloomberg.
Have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize us as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence, all to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 23 minutes into the European trading day. Big news, of course, on OPEC and energy, but you can see stocks for the moment gaining some 0.7%. Now, globally, assets have been hit this year by central bank efforts to tame surging inflation in the UK recently. Things are especially bad. Confidence has been shaken after a mini-budget packed with tax cuts saw the pound hit a record low against the dollar, prompted intervention from the BOE, and eventually a government U-turn amid questions over credibility. Now, in total, 300 billion pounds have been wiped from the combined value of the nation's stock and bond markets. Now, for analysis, let's bring in our UK stocks reporter, Joe Easton. Joe, great to have you on the program. I mean, this was pretty brutal, right? 300 billion pounds wiped off. And this goes, I guess, to the credibility of the markets. Why have the markets freaked out so much?
Well, I think that the big issue here is this all-out push for growth is obviously going to mean higher interest rates across the board from the Bank of England, also the mortgage market, probably going to see potentially a crash in the mortgage sector. And the big issue now looking forward is we really need to see this report from the Office of Budget Responsibility that's going to sum up the state of the UK government finances, because that's the only thing that investors can really go on and really judge how sustainable this fiscal expansion is. So the government can't seem to make up their mind on when that'll come out. Yeah. It looks like it'll come out in the end of November now. And that was actually the big thing that we saw from Fitch last night with their warning on the UK credit outlook. They need to see that report.
Joe, I have to say, I looked at the latest mortgage news. I had to sit down with a drink of my choice to absorb the news. So the key UK mortgage rate climbing above 6% for the first time since 2008. Are you hearing possible defaults or things like that?
Yeah, 6% is the key level that's like red flag for the banking industry. Once it goes above 6%, then it brings into question the health of the debt that these banks own. And that's why we've seen a big sell-off in UK banks. Even since the budget, I think Lloyds, NatWest, companies like that, they're still down around 10% because they're worried that these mortgages will actually go bad at the lower end of their mortgage books. There could actually be big defaults and big provisions booked at the next earnings season.
I mean, this is a huge news that we really are spending a lot of time, and thank you to your team to really keep on top of this. So UK markets, how have they responded to the U-turns by the government? And, you know, yesterday was that Liz Truss speech.
Yeah, so I think the U-turn, it was kind of a strange one, because what it did really was it showed us that the government can actually be reined in a bit. So Kwarteng and Truss can actually be kind of tamed by the MPs on their party that don't want to lose their jobs at the next election. And they're saying, look, you can't just do these tax cuts that won't play well with the electorate. So that was actually a relief for the market. Fiscally, it's only worth around £2 billion in terms of the bill for the budget. But politically, it showed investors that actually this policy of all-out going for growth might not last. We might see the cost of government debt come back down, and that would reduce the interest rate crisis.
Joe, thank you so much. Joe Easton there with the very latest. Interesting to see the more, markets, of course, keeping the government in line and then their own MPs. Coming up, the president of the EU Commission calls for a price cap on Russian gas. We'll have a full roundup of all energy news. This is Bloomberg. to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Welcome back to the Open, everyone. 30 minutes into the European trading day. Here are your top stories. Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So this is a picture overall for equities. European stocks actually advancing, supported as investors weigh the impact of rising oil prices on risk assets. Also, watch out for dollar for the moment. We're seeing a lift on the upside. The FTSE, of course, questions as we have about 3 reports, and all of them, I have to say, are not painting a very nice picture for the UK, gaining some 0.2%, whereas you can see the DAX gaining 1%. Now, this is a sector breakdown, and of course, energy is the one we need to watch for. But for example, the Treasury 10-year yield, and I'm looking here at the Bloomberg terminal, you can do that with Bloomberg anywhere, edging higher, the dollar weakening after its biggest jump in a week on Wednesday, the pound erasing gains. And so some of these sector moves are also based on currencies. We have retail, travel, and real estate on the upside, gaining between 1.2 and 1.9%. We just have a bit of pressure on energy, down 0.8%. So the leaders of 44 countries are descending on Prague for an extraordinary summit being held in the shadows of Russia's war in Ukraine. Now, for European leaders, the focus is still firmly on energy. This comes as Moscow warns against a price cap in a Bloomberg TV exclusive. For more on all of this, let's bring in Maria Tadeo, who's on the ground covering the meeting in Prague. So, Maria, the head of the Commission, Ursula von der Leyen, calling for a gas price cap. Will it actually happen?
Well, Francine, she has, and this is a letter, is 3 pages that she sent out yesterday to the heads of the EU 27 governments, in which she argues when you look at the Dutch benchmark, the TTF, it no longer reflects the true cost of gas, and therefore the European Union has to transition away from it. Now, the issue is you have now 17 countries in the EU that say they are in favor of this price cap. The Commission is responding to that, but the problem is they don't have the formula. And Francine, when we talk about a price cap, there's at least 5 different options on the table. What I hear is that there is no consensus in terms of the formulation, in terms of the structure, and this is what this meeting will be about, to try to figure out a consensus area in which the 27 can live with. Remember also, by the way, that Germany has said up until now they do not favor a cap because of the repercussions it could have on supply.
Yeah, so that's the energy challenge. How much of this is politics? You have 44 heads of state, including Liz Truss.
and she is finally taking part in this European political community. Now, this is a trial run for a concept that in many ways was brought forward by the French President Emmanuel Macron. The idea is that this is a space where EU countries and non-EU countries, but that clearly have the same common interests, can gather together and have a debate. Remember, Francina, a few weeks ago, Liz Truss was asked, is Emmanuel Macron a friend or a foe of the UK? And she could not really put out an answer. She said the jury's out on this question. Perhaps today they can clarify things between the two. And then the other issue that will feature too is this common response to the war in Ukraine. This overshadows everything, as it often is the case in any political meeting that is happening these days in Europe. It's a common response, how to respond to the Russian aggression.
Maria, thank you so much. Maria Tadeo there on the ground for us in Prague. Now, joining us to talk about the economy is Jari Sten, Chief European Economist at Goldman Sachs. Jari, thank you for being here and actually in person in the studio. When you look at some of the challenges out there, I think there's nothing good coming out of this OPEC decision, because they either see a much slower turn for the economy, or it just exacerbates this division in geopolitics. What's the impact for Europe?
Yeah, so we do think the decision to cut supply is going to push oil prices higher from here. We just raised our forecast to 110 later in the year as a combination of tight supply, but then also strong demand as we substitute away from gas into oil. Now, of course, the effect of higher energy prices means, on the one hand, slower growth, but it also means more persistently high inflation. And I think the latter is probably key at the moment, because central banks are still struggling with high inflation rates.
But you're not reading this as a kind of like collapse in demand from China, or a complete recession worldwide that OPEC is anticipating?
I think it's more that you've seen a significant slowdown in growth around the world. It's been pretty broad-based. So oil prices, as part of that, have been falling. And so these supply cuts, I think, are designed to put a floor under that, and are probably going to work to push up oil prices somewhat in coming months.
How problematic is it that these central banks are basically hiking into a recession, into the winter where we also need to heat ourselves?
Yeah, I mean, it's a classic supply shock where you have, on the one hand, higher inflation, on the other hand, lower growth, and we think recession across Europe. So it's a difficult trade-off for central banks. But at the same time, I think they've been very clear that the focus is on inflation. So particularly the ECB has a single mandate, price stability. That's where the focus is, and that's why we think, for now, these pretty large rate hikes will continue, and we don't see a central bank pivot around the corner.
But so the UK also in the mix, which has complications of their own. First of all, where do you see the UK headed? And because of the fiscal spending, that we weren't sure how they were funding it, is it a warning shot to other European countries?
Yeah, I think, first of all, the key issue in the UK is, of course, that it has both the tight labor market that the US has, and also the big energy shock that the euro area has. And so that's really, I think, the context in which we have to see this fiscal expansion, which, of course, is helping to cushion the depth of the recession, we think, but is adding to the medium-term inflation pressures. And so we do think, bottom line here, is that the Bank of England needs to step up the pace of tightening, and we do think they will step up to 100 basis point hike in November to try to rein in these increased medium-term inflation pressures.
What about QT? Is this a mistake?
Well, it has been delayed, and of course the focus has really been on financial stability, on gilt market functioning. I think that has been quite successful, and we do think that they're going to be more cautious with QE, with the asset sales, when they start in coming months.
Just so that we fully understand, because we also had this pretty incredible, mortgage rates hitting 6% the first time since 2008. If there were to be a sharp downturn in the UK, maybe more than you're expecting, where would you see it first, in the housing market or elsewhere?
Yeah, I mean, generally it's about the consumer, the cost of living crisis, high energy prices. So we really think that it's going to be consumption that will drive the economy into recession, and in fact we think we are already in recession. Of course, the fiscal expansion is going to cushion some of that, so we think it's going to be a relatively moderate recession in the base case, but I certainly think that the housing market could be one source of a bigger hit to growth in coming months. And so, for example, with current mortgage rates, the interest payments that households have to do on mortgages could go back up to where we were, in 2007, which of course would imply a further drag on household spending.
Talk to me a little bit about what you're seeing in the U.S. So you have, the Fed not wanting to pivot, and actually you see officials being, quite aggressive. What does that mean for the rest of the world? Because if dollar continues going higher from here, it's problematic for everyone else.
Yeah, so I think in the US, we've seen some progress towards the labor market rebalancing that's needed. So at the end of the day, you have too many jobs relative to the supply. They need to rebalance that. So for example, earlier this week, the JOLTS numbers, the job openings that came down, I think were quite helpful. At the same time, you still have strong wage growth, strong underlying inflation pressures. And so we think it's too early for the Fed to stop hiking. We think they will do a 75 basis point hike in November and some more to get to 4.75%. Now, that does imply, we think, continued upward pressure on the dollar. And so we do think that the European currencies will weaken somewhat more against the dollar. Yeah. And of course, that does raise the pressure on both the Bank of England and the ECB. And so we do think that another 75 basis point hike is very likely for the ECB in October. I think what they do in December depends on how the inflation numbers will evolve, but our base case is that they will hike all the way to 2.75. And of course, the weak euro, the pressure from higher rates in the US is part of that story.
Should they just go 1 percentage point at the next one?
I think 75 basis points is a pretty rapid clip. I think it's likely they do another one, if not two of those, and then I think it's likely they slow down.
All right, Jari, thank you so much. As always, Jari Stender, Chief European Economist at Goldman Sachs, joining us in the studio today. Now, oil prices extending their rally after OPEC Plus defies Washington agreeing to its biggest production cut in 2 years. We'll have a full roundup of that story next, and this is Bloomberg.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Welcome back to the Open, everyone. 43 minutes into the European trading day. We're still holding on to gains, but actually we're seeing a bit of a reversal for the FTSE. That was earlier gaining some 0.2%. The biggest story in town is, of course, energy. The impact of that on energy will be translated, of course, through inflation. Traders weighing this oil curve, Treasury 10-year yields in the U.S. also edging higher. The dollar actually weakening after its biggest jump in a week yesterday. Now, OPEC Plus agreed to cut its output by the most in 2 years, and the EU approved new sanctions on Russian oil, drawing a veiled threat from Moscow. Now, speaking exclusively to Bloomberg in Vienna, Russia's Deputy Prime Minister Alexander Novak says the EU's price cap may backfire.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with a mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Well, that was Russia's Deputy Prime Minister Alexander Novak for an exclusive conversation with our Manus Cranny. Meanwhile, Saudi Energy Minister Prince Abdulaziz bin Salman says the U.S.-led plans for a price cap on Russian exports only adds to market uncertainty.
We wanted to give the market a clear direction, a clear input. That's why we extended the agreement to end of 23. But we still have the same tools in our kit. Guidance to the market is crucial, because without guidance, people would not invest, would not feel safe that they could invest. However, we still have the tools in our kit. We still, we reduced the amount of meeting, we reduced the amount of overall expectations of doing something, but we still maintain the same flexibility. We still have every 2 months we will have a GMMC. That GMMC is warranted the authority to have more than a meeting in every 2 months. It also was given the authority to call for a conference meeting if necessity dictates that.
Part of the toolkit, and the Kingdom has often done this, which is led from the front and gone with voluntary cuts or ads to do the right thing to right the market. Mm-hmm. Did you consider a voluntary additional cut for Saudi?
Well, at this time now, there is no requirement for it. I think amongst us, we sort out a good deal. It's certainly, we had to be very practical, given the situation prevailing in some countries that are not able to produce their allocated voluntary volumes. And because of that, we elected to go for a bigger number, but in the final analysis, it will be a smaller number, but certainly a significant number, and therefore we feel it is sufficient for now.
That was the Saudi Energy Minister, Prince Abdulaziz bin Salman. We'll have plenty more from those two great interviews from our Manus Cranny later on in the program. Now let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Germany factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after the late reporting of some large aerospace orders. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO forecasts global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. North Korea has fired 2 suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles III is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that British officials are converging on that date, although talks are still ongoing. The coronation, almost 70 years after his mother was crowned, will form the centrepiece of days of celebration to mark the beginning of the monarch's reign. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Alice, thanks so much. Alice Atkins in London. Coming up, we'll have more market reaction to OPEC's biggest production cuts in 2 years. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Welcome back to the Open, everyone. So we're 53 minutes into European trading day. We're still seeing gains across the board, but actually not as much as previously. So there's a bit of a pause. Certainly there is in U.S. futures. Look, European stocks modestly higher, but again, it's not the kind of 1% gain that we saw 30 minutes ago. Investors now debating whether higher oil prices would further weaken growth, potentially maybe slowing central banks' rate hike cycles. Now, let's also take a look at how the markets are moving in the first hour of equity trade. Joining us now is Jan Patrick Barnett. JP, the problem actually is that there's a million ways of looking at this OPEC decision. You either think they're seeing something that we don't, or you say, look, this will, of course, fuel inflation, and what do central banks do?
Well, yeah. So it's at this point, I would say it's for the market, for the stock market especially. It's not super bad news, but it's also not great in the sum of all things. So I was talking to a couple of people this morning, and they all said, like, look, this is probably going to keep inflation higher for longer, and that's not something that we want to see at this point. But on the other hand, as long as oil remains below the $100 mark, at least in the long run, then probably people can live with that in some way or form.
So traders, it seems, not taking the hawkish signals from the Fed as gospel. What can you tell us?
Well, I mean, we talked about this yesterday and saying like that people are looking for that Fed pivot point in earnest to drive the market higher. So we didn't get that from the first speeches we saw, but we also did not get a more dovish tone. So that's good news there. I think like a more hawkish tone. Sorry. So that's good news there. But the thing is, like, markets still believe that if the economy is cooling and we are moving into a recession territory next year, that the central bank could probably cut rates, and that's still the playbook that they are positioning for, nevertheless, what the central bank is saying at this very moment.
JP, any chance of this equity rally being sustained?
Well, again, we are in a market that is driven by a lot of short-term technical factors. Positioning has been playing a big role these days, where we have seen like super bearish positioning in option markets and in trend following people. So this has driven the rally so far. And what we would need to see now is like more the fundamental guys, the long-term investors, becoming a little bit more bullish. That's not the case so far. On the other hand, I find it very interesting that everybody is suspecting this rally will not be sustained. That usually, if everybody is on the same side, means the opposite happens. So it's going to be interesting to see if this was a contrarian call to say this rally will not be sustained.
Definitely interesting. Thank you so much, JP Barnett, there with the very latest on some of these stock moves. Now, that's it for the European Market Open. Surveillance Early Edition is up next. Once again, U.S. futures actually stalling. If you look at the oil price action, it's stoking the inflation debate. Now, the decision by OPEC Plus to reduce output really drew a warning from the White House about the negative effects on the global economy. And then we have a breakdown. It's different if you're at Goldman Sachs or if you're at Aberdeen, what you're expecting the target for Brent to be. I think Goldman Sachs, in the fourth quarter, that price target for Brent is at $110 a barrel. We'll have plenty more, of course, on the market action. We'll look at geopolitics as well. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Not so pumped, the U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So first thing is first, let's check in on the markets. We've been bouncing up and down a little bit. I mean, not down, but certainly we opened about 1% higher, and you can see now European stocks gaining some 0.4%. This is all about perception. Do you think that if OPEC cuts a lot and inflation goes up, does it make the central banks more aggressive in hikes, or on the contrary, do you think that it really hurts, tipping the world into a recession, and so are they a little bit more accommodative? If you're on a trading floor right now, this is the thinking that you need to decide on, and that will change your view on some of these equities. S&P futures, you can see now largely unchanged, but on the lower side, a lot of focus because we have 3 surveys here in the UK on whether the UK is still investable. For the moment, that stock price of FTSE 100 is actually unchanged. We also worry about mortgages, now at a 6% high. Let's remember, this is the highest since 2007. The DAX gaining 0.6%, similar to the CAC 40, 0.3% higher. Now, Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, says U.S.-led plans for a price cap on Russian exports are fanning the uncertainty that drove OPEC Plus to its biggest production cut in 2 years. Now, the minister refuted claims that Riyadh is siding with Moscow over the West.
I would say an insulting view to assume that OPEC Plus is nothing but Saudi Arabia and Russia degrading, and too unfair, because from day one, as I took office, I was saying, as a chair of OPEC Plus, I will treat every member of OPEC Plus as equal as any of us, simply because we need the consensus.
Let's head to Vienna, where Bloomberg's Manus Krein is standing by, our news-breaking machine. So, Manus, what's the latest? You had 2 very important interviews, Saudi Arabia and Russia. What did you learn?
There's going to be a vast amount of uncertainty on the implications on the price caps from the Russian side and from the Saudi side. This is what they are perhaps most fundamentally worried about or concerned about. I would just emphasize that I did try to press His Royal Highness Prince Abdulaziz bin Salman on the response in the bunker last night from Jake Sullivan in terms of an SPR release, in terms of potentially NOPEC coming to life again. He would not be drawn on those issues, Francine. We're not here to deliberately jack up prices. We're not going for a jumbo set of cuts. And indeed, he did warn. Yes, you could say they are seeing a 10% rally in prices. That's going to fuel inflation. But as he said back to me on the inflation side, he said, central banks, this vehement commitment by central banks to tame inflation regardless of the impact on growth. Those are the jumbo issues, as it were, that we talked about. But when it comes to price cap, the critical red headline went to Novak. He stole the show in the prints on the headlines. It was about price caps and the impact on production in the near term for Russia. Let's listen in.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 92, 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with a mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Deputy Prime Minister of Russia on his first trip to the heart of Europe, sanctioned by America, access by Europe to talk oil and endure the relationship with OPEC and OPEC+. Price caps are supposed to keep the oil flowing. It's going to reduce Russian production, and it's going to introduce volatility, according to the Saudis, Francine. So those are the messages coming through from both sides here.
Yeah, great interviews. Manus Krani on the ground for us there in Vienna. Thank you so much. Now, we're also joined by Karen Carniol-Tombor, Co-Chief Investment Officer for Sustainability at Bridgewater Associates. Karen, thank you for joining us. I mean, there's a different number of plays outside from sustainability, but of course 100% linked to this. What do you see as the main market schisms that could get us away from more money being poured into sustainable investments?
I think that this environment has helped investors reflect on what their values are and what they're trying to do in choosing to move towards sustainability as a goal. You've had 9-month environment where cash has been king. The tightening, the fact that real yields have been rising and central banks have needed to catch up was the single most important force in markets. So all assets did poorly. And within that environment, the one best performing asset was any kind of energy that got very squeezed. And looking ahead, you're likely to have a very tough environment for investors continuing as policymakers battle between not being able to get what they want on inflation or on growth. And I think that that's left investors in a tough spot, whether or not they prioritize sustainability goals. And those who prioritize sustainability goals, in some sense, more committed given how much the world has changed.
Karen, how has the world changed in terms of perception, but also inflation because of that massive OPEC cut?
I think that the OPEC cut is the news of the day and likely to sort of put a supply bottom, if you will, underneath what could be a lot of downward pressure on all commodity prices from the fact that now you have all these interest rate hikes in the system. And so what's happening is, you had this huge inflationary force coming into this year that was going to show itself both in nominal demand and in inflation, and that's what we got, some of the highest nominal growth we've seen. Now that there's been as many interest rate hikes as we've seen, there is a lot in the system to slow the economy, and that's going to take some time, but it's going to slow the economy. It's going to slow demand. And from the perspective of any price, certainly oil, you have to get some decline demand showing up in lower prices unless supply gets cut. I still think that the decline in the economy that's coming is more severe than expected, and that the supply decline helps put some bottom against that.
But Karen, why do you think markets are still, pricing in this Goldilocks scenario, or are they too optimistic about their own future?
Absolutely. I think markets are pricing in this Goldilocks where somehow magically both we don't have a very severe recession and earnings don't get hurt very much, and inflation sort of magically comes down to where central banks want it to be. I think the reasons markets are doing that is because it's what we've gotten used to. We've had many decades where central banks were able to get what they want. They weren't very constrained. There were so many secular deflationary forces that pretty much every time the economy slowed a little, central bankers could ease massively into that situation, not risk inflation, and inflation would never get out of their control. But the secular environment has changed very significantly. There are big secular inflationary pressures coming into the environment, and I think it's going to take some number of years for markets to adjust to that and realize just how constrained policymakers are and how they're not going to be able to get both the economy and unemployment outcome they want and inflation outcome they want at the same time, which basically necessitates lower equity prices.
So, Karen, if you look at all of these challenges, because of the proximity to Russia, and I guess, the buffer that Europe doesn't have, is it going to be the region that will really underperform the rest of the world?
Yes, I think Europe and the UK have already borne the brunt of this environment because they're the regions that are also having a more secular competitiveness shock. That's a much deeper shock than it's kind of the one-off of COVID, if you will. These are economies that are reliant on having access to at least competitive energy prices relative to the rest of the world to have a manufacturing sector. And that shock, the inability to get energy at the same prices the rest of the world is going to be, and the need to actually ration them, actually experiencing stagflation. It isn't just rising inflation and rising demand, but you actually have to ration energy away from households, away from businesses. That's going to be a very long, much deeper, more challenging shock than to the rest of the world, because beyond getting the immediate, acute phase right now of getting through the winter, there's this long-term competitiveness issue that's going to come. And you see it already with the central banks dealing with much tougher circumstances, wanting to protect households, but already running into what feels like a balance of payments crisis. And those conditions where they realize that, they're going to get currency weakness and balance of payments pressures if they try to print money into rising inflation, and yet they also want to protect their economies.
Yeah, and we have a great chart, Karen. We'll get back to that our Valerie Teitel put together looking at break-evens versus WTI. Karen Carniol-Tombor from Bridgewater Associates stays with us. Coming up, more Fed speakers pour cold water on hopes of an early dovish pivot. We continue the markets conversation next. This is Bloomberg.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
FOMC members Mary Daly and Raphael Bostic saying that the Fed is unlikely to cut rates next year. Now, that's as traders bet on at least one reduction in 2023. Now, Karen Carniel-Tombor from Bridgewater Associates is still with us. Karen, first of all, there is a belief in the markets that, again, going back to that Goldilocks scenario, that they can have it both ways. But I feel like Fed officials have just been saying the same thing, which is we will stop at nothing to keep inflation under control. So if that's the case, if that's your interpretation, where should Treasuries and equities be?
Well, I think that an important thing to keep in mind is that the Fed's job today is actually not that hard yet. I think it's only going to get harder because right now they're in a situation where the economy still looks pretty great. So they can say we're going to prioritize inflation, inflation, inflation because they haven't actually seen any real economic slowing. I think what's going to happen in the next few months is it's going to get a lot tougher because the economy will slow. They've hiked enough. There are enough hikes in the system. And we know from past cycles that there is a lead lag. There's time from the rates rising till you actually get the slowing making its way through the system. So they're going to start seeing, better inflation numbers, worse economic numbers, but be in this spot that's going to feel terrible because they're not going to want to slow the economy further. But while inflation will slow, it's not going to get to the numbers that they're hoping for. So I think it'll be a much tougher call for them in a few months. Right now, my guess is they're going to stay roughly like what's priced in. They're not going to want to kind of upset the apple cart. They're going to try to do roughly what's priced in. Once the economy starts slowing, they'll have a tougher call. And my guess is they're going to need to start having aggressive hikes again in order to make sure that inflation actually gets under control and suffer a lot more economic pain than they're hoping to.
Karen, what's your take on China? Could it be that actually it's much worse than expected, and that would also justify the OPEC cut?
I think that China is worse than expected in the sense that, look, China is the most disconnected economy. It definitely has its own cycle. It's easing and tightening in its own pace. It already has had a pretty deep recession, and it's trying to stimulate relative to that. But its stimulation has not been super effective, and they haven't kind of pulled out all the stops, if you will, because while they're not constrained by inflation, they're the one economy in the world that doesn't have a major inflation problem, they do feel constrained by a lot of other issues. They really want to change the quality of growth. They want to make sure that the property sector actually delevers. They want to make sure that, basically new debts don't get created as a way of responding to the slowdown. And so they're in a situation where they're not really turning their economy around in a huge way. They're not going to be in a deep recession, recession, but they're not going to be the global engine of growth that can offset how weak the rest of the world is going to be.
Yeah.
And that means that, especially from a commodity perspective, oil less so than other commodities, but they're a major source of demand.
Yeah.
And if property sector is the thing they need to slow, that's where a lot of commodities go.
Karen, thank you so much for the terrific briefing. Karen Carniel-Tambor, their Co-Chief Investment Officer for Sustainability at Bridgewater Associates. Now, coming up, demand slowdown, hiring freezes, and the end of easy money. Tech has had a rough ride this year. We'll gauge the outlook at the Investor All-Star Summit next, and this is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize this as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to Tom McKenzie, who's at the All-Star Investor Summit at Hotel Café Royal in London with a guest. Tom, over to you.
Francine, yes, this is a perfect environment to talk about what is happening within the tech sector at a time, of course, of higher rates and valuations coming down. European tech companies have raised about $56 million this year. So it's not all bad news, but of course it is a more challenging environment. And what better person to speak to about this than a partner from one of the leading VC firms across the continent, MMC Venture Partners. And one of the partners, Mina Saman, who joins us this morning. Mina, thank you for coming onto the show. Let's start then with this environment that tech is facing. Higher interest rates, lower growth, and a lot of pressure to cut costs. Is tech being brought back to earth at this point?
First of all, thanks for having me, Tom. I think we're at a quite interesting space within the ecosystem. We came off 2021, which was incredibly high. I think 2022, we're back to more rational investing at the early stage. Yes, companies do have to look at their cost base, and some might say it's a tough time to be a founder, and I'd probably agree with that because you're having to look at your own operations and your runway and when you might next raise capital. So we are seeing across the board some level of cost cutting, but where there's great companies, they will still continue to invest in growth.
I mean, it does bring to mind that famous Warren Buffett quote, when the tide goes out, you see who's been swimming naked. Are you seeing a tick up in failures?
I think there will be. Don't forget, a lot of companies raised a lot of capital last year, so there will be many that do ride the storm, but it's a matter of which companies become the acquirers versus which ones are the ones that get acquired ultimately.
Have valuations troughed?
We've seen them come down, so we invest at the very early stage, so at the Series A, and obviously public markets have come down and that has trickled down. And so at the start of the year, there was a big mismatch between investors and founders just from a valuation expectation, but now we're seeing that come back together for sure.
Some of your kind of most high-profile investments include the delivery service Gusto, but also Copper.co, which provides services to institutional investors within the crypto space. Let's start there. Given the ruptures within crypto, Bitcoin's trading at $19,000. What is the case still for a company like Copper.co in the months and years ahead?
I think you have to think of Copper as not directly impacted so much by crypto, but selling infrastructure, and so enabling big institutions like a BlackRock or a State Street or whoever it might be to have access to those cryptocurrencies. And we're still at a place now where we're seeing adoption through those large institutions, and today is a time where investing in that infrastructure for when the crypto markets do come back, for them to really have a product and products to sell.
What are the investments you're most excited about in the 12 to 24 months ahead?
I think there are a few really interesting areas that we look at, and we're thematic research-driven investors. One of the areas that we're looking at today is what we call data infrastructure software impacting healthcare, financial services, and security. And over the last 5 years, we invested a lot in AI, where data was available, and so you can automate a process or apply AI to do analytics. And over the next decade, we think the value is going to accrue at the infrastructure layer, where new softwares are going to be created to accelerate AI or create new data sets to impact those industries.
Okay, data infrastructure. That is a call there from Mina Saman, a partner at MMC Ventures. Thank you very much for joining us on the views around valuations that we're seeing becoming a little bit more rational within the tech space. Yes, it is a more challenging environment given the run-up in rates that we've seen, and we are starting to see, and Mina is highlighting this, cost-cutting across not just his portfolio companies, but companies across the tech space, as, of course, companies look to become more lean in an environment of slower growth. This is the Europe All-Star Company event. It happens once a year here in London, and it really does focus on some of the innovation, creation, and technology that is driving some of these companies going forward. So it's an exciting time, despite all of those challenges. We're going to have plenty more through the hours ahead. Do stay with us. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot. What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg that an early end to tightening is wishful thinking. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, £300 billion has been wiped from UK stocks and bonds over Liz Truss's first month as Prime Minister. It follows a market rout over her government's sweeping tax and borrowing plans. You can see our next guest sitting to the right of the UK Chancellor. She's one of the top city bosses that the Chancellor met to try and restore market confidence. Well, I'm very pleased to welcome Tina Lee, Chief Executive from the UK and Ireland at Deutsche Bank. Tina, always such a pleasure to speak to you. You make me smarter on what we should be looking out for in terms of pitfalls, but also opportunities. First of all, what's your take on the UK right now? You sat next to the Chancellor. Yep. There's, you know, obviously a credibility problem that was played out in the markets. Can they get back on their feet?
I think they can. I mean, there's been a lot of sound and fury that we have seen over the last 10 days. And I think the work that the Bank of England has done in terms of announcing their gilt purchase scheme has clearly calmed markets. And we've seen that in where sterling has moved to levels where it was before the mini budget. And gilt yields have obviously stabilized, even though at much higher levels. So I think we have a pause here. The question obviously is around the medium-term financial plan. Yep. That is on November the 23rd. That will be coming obviously with the OBR assessment, which I think will be key. And that was one of the things which spooked markets because that was lacking with the mini budget statement. So I think for me, the question is, given that the Bank of England will conclude or allegedly conclude their purchase scheme by October the 14th, what happens between now and the 23rd? So much of that is around, I think, communication with the markets. That was missing.
Which is strange because they also put the markets or certainly the city at the kind of the forefront of their plan.
That's right. That's right. So I think that started to happen. We saw the coordinated statements from the Chancellor and from the Bank of England early last week. The purchase scheme was helpful, and also maybe some of the statements which have been coming out of the Chancellor with regard to his commitment to fiscal discipline.
Tina, when you look at the Bank of England and the fact that they're starting QT, I don't know whether they need to wait or whether this is something that would make a huge difference for your bank.
So QT, I think, is a program that the Bank of England has spent quite some while preparing the markets for. So The Bank of England will still be committed to that programme. What happens, though, is more focused on the short term. In other words, do we actually see a slight adjustment to that programme? Do we see an operation twist type option where perhaps the Bank of England may buy long bonds and actually sell short gilts? But that, I think, remains to be seen. So I think QT is absolutely on the cards, and that's something which we're anticipating is going to actually play into the supply of gilts for 2023.
I think you also have some great new headquarters in London, right, in a year. How committed is Deutsche Bank to London and to the UK?
We are very committed. So I think, as you rightly say, we've got flagship headquarters, which is right now under construction and will be moving in October of next year.
And so what does that mean in terms of your role, though, for your clients? Will your role change given the uncertainty in the UK? So is it, attracting investment? Is it clients elsewhere that see opportunities because of pound, or are people pulling back right now?
No, absolutely not. I mean, we have so many clients here in the UK, and as you know, London is a great cross-border financial centre. So that was actually very much the crux of the conversations that we were having with the Chancellor and his team last week around actually how, as an industry, we can continue to support London as a leading global financial centre and continue to attract capital and talent into London. So I think that is not just about the short term, that's also through the medium term as well.
But the UK, and especially London, seems to have lost quite a lot to Amsterdam in terms of IPOs and things going through the pipeline. Do you think this government understands what is needed to get that back? I know there was also talking about, for example, ministers being able to supersede some of the regulators in attracting IPOs.
Yes. So, I mean, IPOs are really at the end of the value chain.
Yeah.
And actually the focus, and again, some of the key messages that we've delivered to the Chancellor and his team is around the need to support startups, to support seed funding, and actually make sure that those high growth companies actually stay in London, and IPOs actually fall out of that in 2, 5, 10 years' time. So for us, it's a long game. This isn't something that can either change for the positive or the negative overnight. It's really commitment to London as a financial centre that's really important.
Do you think you'd play a role also, further north or in branches elsewhere?
You mean in the UK?
Yeah, in the UK.
We already have over 1,000 people in Birmingham.
Yeah.
So that is a centre which we will continue to be investing in, and we also have operations in Ireland as well. So the UK will continue to be a significant region, really, for Deutsche Bank Group, both in terms of profitability, but also the depth of talent that we're able to source here in the UK.
I have a million questions also on the relationship between the UK and, of course, Europe on clearinghouses and things like that. Would you move people? I know you've already moved some people, right, to continental Europe.
That's right. I mean, for Deutsche Bank, we've always been very fortunate in the sense that we have such a significant operation already, not only in Frankfurt, but in the other European hubs. So we have moved people in the low hundreds. That's working incredibly well. And we continue to monitor where it's best placed for our people to be, both in terms of sales coverage, but also in terms of risk-taking.
What's your biggest challenge right now? I mean, there's a lot happening in the UK. It's also, I guess, trying to get people still to return to the office. I imagine some of them want to work from home. As chief executive of the UK, I mean, you're juggling so much. What do you think is hardest?
So I think the hybrid working side of things, we've actually had lots of people return to the office. As you would expect, sales and trading are in 5 days a week. Yeah. Really, the challenge is around our infrastructure functions, not around getting them in, but actually making sure that there are reasons for them to come into the office. And that's really important. So that's not just about me messaging that I'd love to see more people around Deutsche Bank and around our offices, but also making sure that our leaders and our managers across the whole region really make it worthwhile for our people to come in.
Do you need to pay them more because of inflationary pressures?
Not necessarily. I mean, we're very mindful to cost of living. We're mindful to what inflation looks like here in the UK. I think, as we know, we're expecting CPI to peak at something like 11% by the end of this year. And we're looking at the talent market. So there will be pockets where the market for talent is extremely hot. We seek to remain competitive. We're not looking at wholesale increases in terms of salaries, in terms of addressing the cost of living crisis, but we are very focused on being competitive.
Tina, overall, do you think this government will be business friendly after the mayhem that we saw over the last 10 days? Do you think they'll be good for activity, they'll be good for business, they'll be good for the City of London?
So I think what we have all welcomed is the engagement actually, from this government, both in terms of wanting to hear directly from industry, and I should say not just financial services, but from business more broadly. You know, clearly the growth agenda is a key priority for this government, and will be critical in terms of how the market assesses the medium-term fiscal plan. So it's not a question of top-down. They're very keen to hear from practitioners what we can do to help support that growth agenda.
So what would you need from them? I don't know whether there's too much red tape or, again, it's regulation that needs to be loosened up a bit to be able to rival other European capitals.
So I think there's always room for improvement when it comes to the regulatory framework. However, in my view, I think it's more about streamlining rather than sort of wholesale change and a race to the bottom. So for me, it's very much evolution rather than revolution. I mean, remember, we have some of the most sophisticated regulators here in the UK, and for me, that is actually a necessary foundation for stable and financial markets.
Yeah, but some people say it's too regulated, right? It makes it more difficult because the regulation is so high compared to other places.
That's right, and I think that the government is open to actually hearing that, and I would say actually our regulators are too. So I think watch this space. It's early days, but I think there's lots of areas where the breadth of regulation and the number of regulators potentially can be streamlined.
When you speak to a lot of your clients, are they ready to put more money in the UK in terms of investments, or is it a little bit of a wait and see because of the shock of the last 10 days?
I would say that some clients are pausing. Yeah. And I think that's reasonable. As I said, we have a period of time between now and November the 23rd. We have seen we have seen sterling depreciate somewhat against the US dollar. That's now recovered to about the 112, 113 level, which is where it was before the mini budget. But obviously, I think we should be very mindful of the value of sterling because that does have an ultimate impact in terms of the value of UK PLC.
Yeah. Do you worry? I mean, one of the things that we've been looking at is mortgages, which I don't think impacts you directly.
No, that's right.
But does it impact, I guess, the viability of certain firms? Do you worry that certain customers in the UK will go bust because of what we'll live through in the next four months?
So I think, as you said, for Deutsche Bank, that's not a sort of a relevant impact. So for us, it's really second order in terms of the impact for us. We really are focused on speaking with our UK clients and really helping them navigate what are really tricky markets in a rising interest rate environment.
Tina, thank you so much, as always, for joining us. Tina Lee, their Chief Executive Officer for the UK and Ireland at Deutsche Bank, joining us for an exclusive conversation on the City of London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO is forecasting that global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after the late reporting of some large aerospace orders. North Korea has fired 2 suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that the British officials are converging on that date, although talks are still ongoing. The coronation comes almost 70 years after his late mother was crowned and will form the centerpiece of days of celebrations to mark the beginning of the monarch's reign. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Calls for a street party, Francine.
Always a street party. I'm always in. You organize, if I get my voice back. This is, Leanne, all the street partying that you and I have been doing. Except you keep your voice. I lose it. This is the problem. OPEC Plus, let's get back to business. OPEC Plus defies Washington, agreeing to the biggest production cut since 2020. Now, we'll bring you the very latest on that next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, OPEC Plus has agreed to cut its output by the most in 2 years, earning a rebuke from the White House. Meanwhile, the EU approved new sanctions on Russian oil, drawing a veiled threat from Moscow. Now, let's head to Vienna again, where Bloomberg's Manus Krani is standing by. Manus, first of all, great interviews. So what's the latest?
Fran. Well, the latest is job done, isn't it? Mission accomplished. Markets up 6, 7, 8, 9% in the space of 4 days, or is it? Are we about to embark on a very serious period of conflict, having Joe Biden expended a great deal of political capital on a rapprochement which might be under reconsideration? The message is very clear. We're worried about price caps. The message is doubly clear, which is for Russia, price caps could mean production reductions. But the Saudi minister, His Royal Highness Prince Abdulaziz bin Salman, we're not here to deliberately jack up prices. No, Manus, I'm not setting the stage for jumbo cuts to come. This is about moving on from a monolithic issue, which was COVID, in splendid isolation, to a whole host of uncertainties. But of course, this was the issue as to whether he likes to keep speculators ouching like hell, and whether that job was done. Let's take a listen to the Prince.
Masochist when I said this, but I was talking about more to do with making sure that we have disciplined market, a market that serves its original purposes, which is a market that has sufficient liquidity. That liquidity has been hampered by extreme volatilities. Extreme volatility, unfortunately, bring premiums to become very expensive.
And that market is still fragile, it is still illiquid. There's a warning shot there from His Royal Highness. But of course, it's about the volatility, Francine, that could come from price caps. And that's perhaps the deeper story at play here in OPEC Plus. The known unknowns and now the unknown knowns. Francine.
Yeah, I feel like it's all falling apart. What's next for Saudi-U.S. relations?
I think Saudi-U.S. relations are going to be tested. This is where, you know, the adults need to stand up in the room. You've had the Biden, Jake Sullivan immediate response in the depths of the press conference. SPR, you want to cut? You want to cut by 2 million barrels a day? I will see you and raise you. I'll go for an SPR release. And you know what? If you want to get frisky with me again, I'll unleash the hounds of Congress and raise the specter of NOPEC. That might get everybody ouching a little bit more in the building behind me. But when it comes to the Russians, they are much more focused on the price caps. But these relationships between the USA and America, his brother came and fist bumped the President of the United States of America. That's called global political capital. Francine.
Yeah, it certainly is. Manus, thank you so much. Manus Cranney there with the very latest and, of course, talking about his 2 great interviews. Now, sticking to energy, for more on this, let's also get in Maria Tadeo, who's live for us in Prague this morning, where an extraordinary summit is being held. So, Maria, the head of the Commission, Ursula von der Leyen, calling for a gas price cap. Will it actually happen?
Yes, she hasn't, Francine. Now she's put it on paper. This is a letter she sent out to all the heads of states of the EU 27 countries yesterday, in which she argues when you look at the prices in the Dutch benchmark, the TTF, it no longer reflects, according to the head of the Commission, the real cost of gas. And therefore, the European Union needs to transition away from it. And that means temporarily a cap. The problem is, and this is the fundamental issue, is that you have a growing number of countries that call for it. The Commission now responding on paper, but they can't agree on a formula. When we talk about a price cap, Francine, there's at least 5 different options on the table. And then the other issue is that Germany is still not behind this idea, and then there's the ramifications potentially. If prices do go down, then maybe demand destruction will not be as intensive as it needs to be. So then you're back to square one.
Yeah, the problem with all of that is that there's also politics in the middle. So what happens in the politics? You have 44 heads of states, and I think the UK Prime Minister is also arriving.
Yes, and Francine, she is here today. It's finally confirmed. Remember, at one point, there was questions as to whether or not she would attend this meeting as a European political community. Of course, countries that are members of the EU, but also others that don't. And the idea here is that they can sit around and debate issues they have in common. Now, for Liz Truss, she gets to step away from her domestic problems for a few hours, potentially meet with Emmanuel Macron. Remember, a few weeks ago, she was asked, is he a friend or a foe of the UK? And she said the jury's out. Maybe today they clarify issues, also issues around Brexit. And then you have the Ukrainian question, which is still the perennial debate here, especially because the Turkish president is going to be here too, and he has been key in that grain deal, which could perhaps expire going into the winter. So there's a lot of Ukraine too here.
Maria, overall, I mean, when you look at the different players, who are the heads of state that you'll be watching out more closely for?
Well, Francine, today really is Emmanuel Macron. This is his baby to some extent. He was the one that pitched this idea. And when I spoke to French diplomats yesterday, they say to some extent this is already a win for French diplomacy. The fact that we're here today in Prague and this meeting is called the European Political Community may actually help to reset some of the difficult relations like the UK, but not only. And then, of course, it's Olaf Scholz. You know, there's a lot at play with that mega package, 200 billion euros. Remember, Francine, it's sparked a lot of tensions, and there is a feeling here that Germany still has some explaining to do.
Yeah, that's absolutely right. Maria, thanks so much. Maria Tadeo there in Prague for us. Now, coming up, we stay in Vienna throughout the morning to bring you the very latest on OPEC's biggest production cut in 2 years. This is Bloomberg.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm from Sinlacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Elon Musk and Twitter have agreed to postpone the billionaire's long-awaited deposition in the company's lawsuit. Musk reversed course earlier this week and said he was committed to going ahead with the $44 billion takeover. The move comes as lawyers trying to finalize procedures to dispose of Twitter's lawsuit. Now, German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after late reporting of some large aerospace orders. Virgin Atlantic is pulling out of Hong Kong for good. The UK airline is cancelling flights and closing its offices in the Asian financial hub, ending a 30-year history with the city. It says one key factor is closed Russian airspace, which extends flights between Heathrow and Hong Kong by at least an hour. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons in New York, and Edwards in London, and this is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This has been an incredibly tough year for the bulls. It's been a great year for the bears.
There's a lot of distortion in the data.
It's really about finding what's going to work in a persistent high inflation environment.
I think that there's a concern in the broader financial markets that something might happen within the U.S. markets.
It's just the uncertainty factor that's keeping markets on edge.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Traders versus the Federal Reserve. They keep betting that the central bank will cut rates next year, even though Fed policymakers keep saying that they won't. The OPEC plus oil production cuts. The Saudis snubbing President Biden and helping Putin. And European leaders meet in Prague. The summit will be dominated by the energy crisis and the war in Ukraine. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, the European market's kind of catching up with the US of yesterday today. The global vibe, though, seems to be trying to work out what the significance is of those production cuts from OPEC, what that does to inflation and to global growth.
Yeah, and we're going to have more on those stories in just a minute. And of course, by extension of wondering what it means for inflation, there is a question of what it means for central bank policy, as we've had the pivot conversation revival in recent days. And of course, that is something they also pay attention to in Asian markets, where it really was a mixed picture for equities overall. You did have the MSCI Asia Pacific Index as a whole up about 0.3%, in part due to gains in markets like Japan. But you had some underperformance as well coming from Hong Kong, which saw some of the gains of yesterday, the best day for 6 months in the Tuesday session, retreating a little bit, with the Hang Seng down about 0.4%. Now, as I raised the central bank question, of course, you've had Fed speakers pushing back on the idea of a pivot, pushing back on the idea of rate cuts coming in 2023, and that has put some more upward pressure on bond yields. In Australia, for example, overnight, the 10-year yield rising 14 basis points to the 377 level. One interesting thing I wanted to point out in foreign exchange as well, the South Korean won stronger against the dollar for a fifth day in a row. That is its best 5 days against the dollar going back to the spring of 2020, strengthening by about 0.6% this morning, trading right around the 1400 level, Matt.
All right, we are looking at S&P futures that are down this morning after a down day yesterday. Although it should be mentioned, we were off a lot more, and Wells Fargo has come out and said they believe that one options trade yesterday provided a big bounce in the market because market makers had to reposition themselves by going out and buying the underlying equities. So really interesting trade. Great story in the Bloomberg. Recommend you check it out. Nonetheless, looks like we're headed back down again today. Only 0.4%, not looking at the 1% plus drops in futures that we saw yesterday at this time. We do see the Bloomberg Dollar Index starting to climb a little bit, though. And if you looked at the chart, the one-day chart of this, you would see that it had come down and is now going much further back up. So the gain of only 0.1% in the dollar index doesn't look terribly significant until you back out and see from where we've come, or from whence, maybe? I got to ask Anna about that. The 10-year yield right now barely changed, but at 3.75, so still at a relatively high level. And again, this is a case of a yield that was down and has come back up through the unchanged level into, well, for a moment, into positive territory. Nonetheless, the point is it's come up from a lower level. And NYMEX crude as well, 87.82, after the big cuts that we got yesterday from OPEC and all the surrounding stories about how OPEC may be siding now with China and Russia. We saw some gains in this market, although they're not quite so pronounced. You see 2 million barrels a day, Anna, and you think we're going to see a huge jump. We have seen forecasts, though, for bigger gains, in Brent especially, right? Goldman Sachs says 110 a barrel now by year end.
Yeah, absolutely. From whence we came, I don't know, sounds maybe right, Matt, but even here in ye olde England, that sounds a little old-fashioned, so maybe not. Let's have a look at European markets. We've got European stocks giving us a pretty kind of mixed picture right now, fairly flat, either side of the flat line, down 0.25%, and that is, again, an oil story, down by 0.25% there. The CAC 40 fairly flat, the DAX up 0.1%. Let's have a look at where we are on some of the fixed income stories and energy stories across Europe, because these are having an impact. There's a big focus, once again, on the long end of the UK gilt curve. Yes, we know the Bank of England is operating here. Yes, we know that they're doing quantitative easing. Essentially, they're buying some of the bonds in the market there to stabilize the market still. They haven't been doing that so actively over the last couple of days, but a lot of people are asking what happens when we get to the end of the cliff edge. We've seen mortgage rates rising in the UK, and that's adding to concerns about how this spreads into the underlying economy. Conversations going on about that. The Italian 2-year yield in focus as well. We had seen this yield rising. We've seen the 10-year yield rising up till pretty recently, and a lot of this to do with concerns about where BTP yields go if we start to see the new government in Italy trying to take fiscal action to support the economy there. One of the ratings agencies out with a warning to watch that and watch those developments. Brent crude, Matt's already talked about where we are on oil, only up by 0.2%, to Matt's point about how we haven't seen outsized reaction perhaps to those cuts in production. Are they really going to be as much as billed? And have we seen a big run-up in prices in the expectation of these cuts? Both of those could be true. But as Matt says, 110 is the call now for some. We've seen Goldman Sachs, Morgan Stanley, and UBS all talking about going north of 100. And Shell, despite the fact that we have a broadly supportive environment for oil prices, then Shell is losing ground today, down by 4.4%. They put out a trading update, Kaylee, and some analysts talking about that being a little bit weak in terms of their performance.
All right, Anna, well, let's get back to the central bank story, because Fed officials keep repeating the mantra that they don't plan to cut interest rates next year. San Francisco Fed President Mary Daly and Atlanta Fed President Raphael Bostic were the latest to bang the drum on the need to keep tightening in place to reduce inflation. Mary Daly spoke to Bloomberg's Michael McKee in an interview yesterday.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
Bloomberg's Danny Berger joins us now for more. So, Danny, their message is clear. The question is the market receiving it?
No, not really, to put it just flatly, Kaylee, because we are still pricing in cuts for next year. So for our radio listening audience, I have the euro-dollar curves up on a chart in front of me. I'm looking at next year's, what's implied for rate cuts, and for 2024. So at the moment, we're implying one rate cut in 2023 of 25 basis points and at least 2 in 2024. Again, this is not what the Fed is saying. Both Daly there and Bostic yesterday saying we're going to hike rates, and then once we get there, we're staying at this restrictive level to make sure that we have conquered inflation. So that's potentially why we will see more jittery markets against things like tomorrow's payrolls report, because we're looking out for any of those clues if there are cracks that would allow them potentially to cut next year. But for the time being, no, the markets are not listening to the Fed saying that they will keep rates restrictive.
Danny, I also saw a great story on the Bloomberg last night pointing out that world currency reserves are shrinking to the tune of about $1 trillion, or about 8%. That's a big drop.
Not only is it a big drop, Matt, but for that level of it happening in the first half of the year, that's the most that we've ever seen since the Bloomberg data, which goes back to 2003. At heart of the issue here is the fact that the dollar is rising, so all of a sudden things like euro, yen, all those other reserve currencies, they've become less valuable. Then at the same time, you have treasuries selling off, so if these foreign reserves are in the form of treasuries, that's all of a sudden less valuable. And these countries are spending on energy. So it just means that the firepower they have in their tank to spend to defend their currencies is significantly lower, because they're not going to get the same amount back, for example, if they were to sell off treasuries or US denominated assets right now. And so at the moment, a lot of these countries still have enough FX reserves to continue to defend their currency. But the thing is, the Fed, as we were just saying, isn't going to pivot. So this could potentially just continue to deteriorate and continue to deteriorate the firepower of countries to defend currencies.
Yeah, and absolutely. And Danny, we've talked a lot about, of course, the Japanese doing this, but India, the Czech Republic, others also spending big on that front. Danny, thanks very much. Bloomberg's Danny Berger with the latest on those market themes. Let's turn to one of the important drivers today, and that is oil policy. OPEC Plus agreed to make a large production cut to keep oil prices high, drawing an immediate rebuke from the United States. The move was defended by ministers from the producers group as necessary to protect the oil industry and their own economies from the risk of a global slowdown. Bloomberg's Manus Krani joins us now from Vienna. Manus, what did you walk away with from the last 24 hours? What stands out to you?
Look, I think it's a confluence of C's. It's the cuts which are sizable, but how real are they? The cuts, the caps, the price caps that are coming, the capital, the political capital which has been expended by the White House, and in some ways perhaps rebuked by not just Saudi alone, but by the OPEC Plus, by the arrival of Alexander Novak here in the heart of Europe, the Deputy Prime Minister. But they're not deliberately trying to jack up the price of oil. Both sides, the Russians and the Saudis, exclusively speaking to Bloomberg, talking about their concerns about the price caps. You know, price caps are supposed to keep the oil flowing through the system, but the risk to Russian production is very clear. That's going to drop. Who's going to fill that void? But of course, it is the lack of precision detail that's going to deliver more volatility on a growth shock as well in the next couple of months. Let's listen in to His Royal Highness Prince Abdulaziz bin Salman on his take on caps.
Lack of details and lack of clarity, and the lack of the fact that we still have 2 months to go for that these two things to be activated. These 2 months will be a period of uncertainty. We don't see what will be the reaction of the market, of the participant.
His Royal Highness also wanted to be preemptive, Anna, and went on. We talked about inflation and the dollar, and this is going to stoke inflation. This is going to refuel inflation. And he said to me, he said, Manus, he said, there's a vehement commitment by these central banks to tame inflation at any cost to growth. And that's perhaps part of the narrative about why, potentially why, they're taking this preemptive action in terms of cuts, or else there's some pretty awful data that they've seen that we haven't quite worked out.
All right, well, Manus, you hinted at the conversation you had with Russian Deputy Prime Minister Novak, as you said, in Europe, days after being sanctioned. What were the highlights from your discussions with him?
A couple of big takeaways, Kelly. Good to be with you, which is they're not really talking about potentially cutting off the gas through Ukraine. That's in the depths of the interview. Go and listen to it. Wouldn't exactly respond, but it certainly doesn't sound as if cutting off the gas route through Ukraine is really on the table. That's point one. The second and perhaps more important point is, are you at an energy war with the EU? He said, no, it's not an energy war. It's a special situation. So again, go back and listen to that. It's about reframing the narrative. He's sanctioned by your country, by the United States, but he is not sanctioned by the Europeans, and he is flowing in here. I think in the weeds of all of this, I want you to take away one thing. The OPEC Plus agreement has been extended. There is no sign of fracture between the OPEC family and the Plus family, which is Russia. And that is causing the air of the White House. And I'll tell you what, the hounds have been unleashed. more SPR, more oil from America, counter your cut. And I tell you what, His Royal Highness likes to keep the markets and the speculators ouching like hell. Well, I'll tell you what, if NOPEC comes to life in Congress, it could keep a few people here and in the hotter climates as well of the GCC ouching like hell.
Manus, thanks very much. Bloomberg's Manus Craney there reporting from Vienna. We're going to have more on his oil interviews later on in the hour. Right now, I want to talk about the leaders, another energy story really, the leaders of 44 countries descending on Prague for an extraordinary summit being held in the shadows of Russia's war in Ukraine. For European leaders, the focus is firmly on energy. This comes after Ursula von der Leyen, European Commission President, proposed a gas price cap. She spoke to the European Parliament yesterday.
Such a cap on gas prices must be designed properly to ensure security of supply, and it is a temporary solution to cater for the fact that the TTF, that is our main price benchmark, is no longer representative for our market. Introducing a cap on gas overall is a temporary solution until we will have a new EU price index developed that ensures a better functioning of the market.
Bloomberg's Maria Tadeo joining us now in Prague. Maria, the head of the Commission, von der Leyen calling for a price cap. Is it actually going to happen?
Well, she has, and Matt, she's now put it in paper. This is a letter that she sent yesterday to the EU 27 heads of states, in which she says, when you look at the Dutch benchmark, the TTF, it no longer reflects the real cost of gas. We have to move away, but in the meantime, there'll be a cap. The issue here, and this is fundamentally the problem, she has a growing number of countries in the EU that call for it. The Commission has to respond. But when you look at a cap, the problem is there's about 5 different versions of it. It's not clear what the formula would look like. And then on top of that, you have the political tensions that come with this. When you look at countries like Germany, they say they worry about the supply and the impact that this would have. And then, of course, the ramifications that could come with lower costs. The idea is that to get ahead in the winter, you need storage, you need supply, but you also need demand destruction. If prices go down, then maybe people will turn on the heat. And so you can see that this is incredibly complicated and very complex, as it often is when you look at a continent that essentially has 27 different systems.
Maria, thank you very much. Maria Tadeo with the latest from Prague. Kaylee?
All right, Anna, well, let's take a look at some of the stocks moving in pre-market trading here in the U.S. as well, and keep an eye on some of those company stories. Of course, the one that has caught all of our attention this week is Twitter and Elon Musk. We are still awaiting further progress on that deal after Elon Musk said he wants to go through with that $44 billion buy. The question is, will the financing line up? What happens with the lawsuit? There is still a lot unanswered. And as a result, you still have Twitter shares trading below that $54.20 offer price. Right now, Twitter trading at $50.86 this morning, down about 0.9%. And Tesla, for its part, down about 0.8% in early hours. There is also a question of whether Elon Musk has to sell some of his stake in the EV maker in order to fund that deal. One stock moving higher, though, is Pinterest. Goldman Sachs upgrading the stock overnight to the equivalent of a buy rating, putting a $31 price target on the stock. That would imply more than 20% upside from where it closed yesterday, 26% upside, I believe. It's higher by 5% in pre-market trading this morning, right now trading at $25.90, Anna.
Okay, we'll keep an eye on Pinterest. Coming up on the program then, Kaylee, we will talk to Matt Maley, Chief Market Strategist at Miller Tabak. We'll get his perspective on the pivot, no pivot, what's the latest thinking there, and a $100 billion bust. Self-driving cars were supposed to be the future, but detractors are getting louder as the losses are getting bigger. Read more in today's Big Take on Bloomberg.com or on the Bloomberg Terminal. This is Bloomberg.
possible the industry is in an arms race that will lead to spending itself into an oversupply. I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. And it's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. I'm looking at a chart here for those of you listening on radio that shows the estimate for GDP going into next year. Clearly, it's down as markets are expecting a recession, as well as the estimate for core PCE, which the Fed really focuses on. That continues to rise. So the question is, why do we see expectations of, reportedly, a Fed pivot driving markets up, as we did on Monday and Tuesday? Is it that the market expects a recession and the Fed to turn around in the face of that? Or is it that the market expects inflation to come down, which doesn't look like the case from this chart? Let's bring in, is Simon White with us? Simon White is with us right now. Simon, you wrote a fascinating piece for the Daybreak newsletter, which is why I wanted to have you on this morning. I thought that the market maybe expected inflation to come down, which is why they think the Fed will cut, because the Fed has been really vehement that it is going to only lower rates when inflation gets back to 2%, not because the economy falls into a recession.
So, yeah, it's very curious. The bear market we're in today is, one of the 20% worst bear markets since 1929. So the equity market's kind of saying a recession is coming. But the curious thing really is that you'd expect lower prices would increase the probability of lower prices still. But if you look at option markets, what's actually happening is that the sort of demand for crash insurance is relatively declining. So the market's kind of saying, yeah, lower prices, we might have a recession, but also it's basically saying that the Fed put is getting closer. So therefore, there's no as neat demand for this sort of crash insurance.
Okay,
as
so
there was
reduced
before.
need to go out buy that insurance, even though you see downside not as much as before, or at least you think the Fed has got your back.
Yeah.
Essentially, I thought we'd been all retrained away from the Fed put, Simon. I thought we weren't supposed to expect that anymore. The Fed is laser focused on inflation, and so the equity markets can just keep selling off regardless.
It's been conditioned, I think. I mean, as much as the Fed has gone out of its way to say this is different right this time, the equity market is basically saying, we don't believe you. When push comes to shove, the market's down, 25% at the max off the highs. That is bad, but I mean, it could get a lot worse. They're saying it's probably not going to.
Hello, traders. How are you doing today? I'm going to place an order to sell short Bitcoin. If you look into trade Bitcoin, the price I'm looking to sell 20,000 to 18. 20,218 pounds. Okay? Okay, let's place order. So if you want to get the strategy, you need to go to companyeye.co.uk. If you want to follow my trade to see how we will make profit from this trade, just stay with me and I will guide you through this trade as soon as the trade trade will fill. Okay, Stay safe, guys. I'll speak to you later.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot
of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight. You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. North Korea is ratcheting up the tensions in the region. It fired 2 suspected short-range ballistic missiles toward waters where a U.S. aircraft carrier had been deployed. Earlier this week, Kim Jong-un's regime launched its first rocket over Japan in 5 years. North Korea criticized the U.S. for redeploying an aircraft carrier group to waters east of the peninsula. And Bloomberg has learned that before Elon Musk renewed his offer for Twitter at full price, he was seeking a discount. Musk's representatives and Twitter held talks in the last few weeks about a buyout for less than $44 billion. The New York Times says he was looking for a 30% reduction. And of course, that is one of the individual stock stories we continue to watch, but we are also watching stocks at large as we consider the potential of a Fed pivot or a cut coming next year. We'll look at how optimistic this market really deserves to be. Matt Maley, Chief Market Strategist at Miller Tabak, is joining us coming up. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Traders versus the Federal Reserve, they keep betting that the central bank will cut rates next year, even though Fed policymakers keep saying that they won't. The OPEC Plus oil production cuts, the Saudis are snubbing Biden and helping Putin. And European leaders meet in Prague. The summit will be dominated by the energy crisis and the war in Ukraine. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, European equity markets have been just catching up really with the moves higher on US markets yesterday. And broadly speaking, globally, investors trying to come to terms with what it means for OPEC to have cut production, what that means for inflation and for growth.
Yeah, for sure. And you know, higher oil prices are maybe bad for equities. We did have a big move lower in yesterday's cash trade, but then a jump higher. As I mentioned earlier, Wells Fargo thinks that was fueled by one big options trade, a $31 million options trade. I think is a really fascinating theory. Check it out. There's a story on the Bloomberg terminal. We have what looks like not a lot of moves. Now, it's days like this where I'm kind of wishing for Dan Curtis's, 4-panel GIP screen, because then you could see that we have a lot of drops and jumps, just like yesterday's equity market. The S&P futures are down, but only 0.4%. So maybe we didn't just see the options trade. Maybe it was the jobs number that also helped the moves yesterday, because otherwise this number should be a lot lower. We do see the Bloomberg Dollar Index right now just above unchanged, but it had also been lower earlier, and I believe the dollar is still up against the pound and the euro. The 10-year yield was down earlier. It's back up now, a little over 1 basis point, but to 376.5 at a relatively high level, and this is a problem for equities as well as the oil price, which is at $88.09 a barrel. This is for Texas Intermediate. Of course, Brent is up above 93, and we've seen forecasts from Goldman Sachs, for example, for Brent now to rise to 110 with those production cuts, which is, of course, a problem for manufacturers and anyone who uses energy like me and my truck. Kaylee, what do you see in the pre-market movers?
It always comes down to you and your cars, Matt. We know you better than that. Now, speaking of cars, Tesla is one stock to watch in pre-market movers, specifically as it relates to Twitter, because there is a lot of questions about that $44 billion deal from Elon Musk to buy Twitter that he wants to go ahead with. Will it go through? We still don't actually know for sure. As a result, Twitter is still trading below that $54.20 offer price right now at $50.79, down just about 1% in pre-market trading, while Tesla, coming back to the cars for you, Matt, down about 0.9%. But really, that is kind of in keeping with what we're seeing more broadly in large cap technology, and that is that they are mostly in the red in the early session here in the U.S. NVIDIA is down by about 1.1%, and Apple down by 0.5% as well, Anna.
Kaylee, European equity markets then making up for lost ground when it comes to the US session of yesterday, up by 0.2% on the Europe Stocks 600. These are some interesting moves in bond markets to get to, and we're seeing selling of bonds broadly across the European space today, but this is government bonds. But we do see, and we see a move higher, therefore, in the 30-year UK gilt yield. And this is in focus because we're getting closer and closer to that cliff edge that's been created by the Bank of England stepping in at the long end to try and calm markets, essentially, after we got that so-called mini budget. What's interesting in the last hour, we've just heard from John Cunliffe at the Bank of England saying that the Bank of England actually identified on the day of the mini budget that there was a risk to the pension system and some of the insurance products that it relies upon. And so that's interesting because perhaps it suggests there was quite low tolerance, low buffers, risk buffers, if you like, for what was going on in markets there. So we'll look for further details on how the market readies itself for normal functioning mid-October. The Italian two-year yield also a little bit higher, but really the questions here are around what the new government is going to do. One of the ratings agencies out with a note on that. And Shell down by 4.2%. This on the back, Kaylee, of a trading update from the business. Despite the fact we've seen higher oil prices of late, we've seen OPEC cutting back on production, Shell moving lower on its trading update, which some investors, or some analysts rather, have described as a little bit weak.
All right, Anna, well, that is one equity story we are watching today, but let's talk about equities more broadly now. Joining us is Matt Maley, Chief Market Strategist at Miller Tabak, up early in the morning for us in Massachusetts, which we always appreciate. Matt, it feels like the market is trying to decide if something has changed this week. The Federal Reserve, the speakers we are hearing from, is telling us nothing has changed. We are still staying the course, going to fight the fight on inflation until it is done. We are going to keep rates higher for longer. The market still, though, thinks now that they're going to cut in 2023. How optimistic are you about that possibility and what it means for your view on equities?
Well, I'm not very optimistic on that view. However, you know, what I think a lot of investors are doing right now, especially on the institutional side, they're really we're seeing. The biggest issue is what happened with Credit Suisse, and people are thinking, oh my gosh, maybe something is broken. You know, a lot of people have been saying for a long time that the Fed will keep tightening until something breaks. Well, did something break? I mean, I think a lot of people are worried that that's what happened with Credit Suisse, and therefore the Fed will have no choice but to pivot early next year. I'm not so sure that that's true, but if Credit Suisse is, you know, there's definitely some issues there. But once those seem to be those issues calm down, we still have to worry about a recession. I mean, the market right now is still on the expensive side, and if we go into a recession, what happens in every recession, at least since World War II, is earnings have gone down. If earnings go down in a market that's already slightly expensive, they're going to get even more expensive. The market's going to have to come down further. So whether we see a further rally over the next several weeks, I still think it's going to be a good opportunity to take some chips off the table.
Just so I get a better understanding of what has gone wrong at Credit Suisse, Matt, you know, they have a Tier 1 capital ratio of like 13.8%, very strong, right? So they're not looking to face liquidity issues in the near term, but it's been a lot more expensive to insure against a default in their bonds. Doesn't mean they're going to default. Their equity fell to an all-time low, and it looks like some market participants have pulled back in terms of, you know, giving them equities to give out to short sellers. What specifically is the concern around Credit Suisse?
Well, I think the biggest concern really involves their derivatives book. I mean, you know, we have the banking. At least I don't think anybody's really talking about a repeat of 2008. But you know, if people start, you know, we're worried about counterparty risk, I guess, as people worry about, geez, if they're going to fail or if they're not going to live up to their obligations, suddenly a bunch of hedges out there aren't hedges anymore. When they go to get their hedge, and a bank like Credit Suisse would say, "Sorry, we're failing," that unravels a whole lot of hedges, and that creates a big problem. So that's the concern. Whether that's a real risk or not, we don't know, but that's, I think, really what the markets are betting on right now. That something with Credit Suisse will force the Fed to, even if they don't pivot, at least they'll pause. I don't think that's enough to really keep the market from falling further, but it could buoy it for longer than I had been thinking a week ago.
Well, yesterday we heard Mary Daly tell Michael McKee that she wants to raise and hold, which I thought was a little bit more bullish than raise and raise, right? And in terms of the pivot, you know, the Fed has been very clear they're only going to cut rates once inflation gets back down to close to 2%. Now, what do you think they mean by that? Is 4% close to 2%? Does it have to be 3 or less? Do you think they have a set number in their head? Because inflation, especially after the comps of this year, next year is going to be much weaker.
Well, the biggest concern I have is that even if it's, people say, well, geez, maybe they'll raise it to 4%. That's going to be good. How good is that? I mean, really, again, in a stock market, because if we're at 4%, suddenly those, 17, 18 times earnings valuations that we've been used to for a while no longer are valid. You get the higher those interest rates are, the lower the multiple has to be, and we're not there yet. So again, I think this is a situation where people are getting, they're thinking, oh my gosh, if the Fed is not going to be quite as hawkish, therefore they're going to go back to QE, and that's just not going to be the case. We're not going to be able to have those valuations. So again, if we get a rally in the fourth quarter here, I don't think that's going to bode as well for next year as a lot of people think, because we're heading for a recession. That's just not good.
Matt, I spoke to a guest earlier who told me that in his view, the pivot means stopping hiking. Others seem to think that a sufficient pivot for risk appetite could be stopping hiking so much. And some obviously think that we need to see cuts in interest rates to be a full sort of pivot. How are you thinking about, are we thinking about it in too binary a fashion, what a pivot from the Fed might mean?
Yeah, I'd say, should it be pivot or just a pause enough? I mean, again, that it'll be better for risk assets if the Fed doesn't keep tightening, but it's not going to be better for inflation. Inflation will create a problem. It creates stagflation, et cetera. I mean, it's going to have a negative impact on earnings, I guess is my point. And so that you do need, again, if you want to go back to what we saw before the Fed started tightening, you need a cut in interest rates and QE to justify those high valuations. And we're just doesn't seem like we're going to get that. My point is that a pause is not enough to help the market rally a lot. And maybe it helps it from selling off as much as people have been worried about, but I think it eventually will cause the market to go lower because, again, without QE, the market was artificially high because of QE and zero interest rate policies. We're not going back to that kind of policy, at least from everything the Fed is telling us.
Matt, thanks very much. Thanks for your input. Matt Maley of Miller Tabak. Coming up on the program, we'll get further insights on oil, part of our interview with the Russian Deputy Prime Minister Alexander Novak, and also our conversation with the Saudi Energy Minister. All of that next. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, OPEC Plus agreed to cut its output by the most in 2 years. The alliance plans to slash daily output by 2 million barrels a day. That move drew a rebuke from the U.S., which has been seeking more oil from producers. Russia's Deputy Prime Minister Alexander Novak spoke exclusively to Bloomberg in Vienna.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
That was Russia's Deputy Prime Minister Alexander Novak emphasizing cooperation between OPEC Plus members. Meanwhile, the Saudi Energy Minister says the United States-led plans for a price cap on Russian exports only add to market uncertainty.
We wanted to give the market a clear direction, a clear input. That's why we extended the agreement to end of 23. But we still have the same tools in our kit, Guidance to the market is crucial, because without guidance, people would not invest, would not feel safe that they could invest. However, we still have the tools in our kit. We still, we reduced the amount of meeting, we reduced the amount of overall expectations of doing something, but we still maintain the same flexibility. We still have every 2 months we will have a GMMC. That GMMC is warranted the authority to have more than a meeting in every 2 months. It also was given the authority to call for a conference meeting if necessity dictates that.
That was the Saudi Energy Minister there. Let's get some expert analysis. Will Kennedy joins us, Bloomberg Senior Executive Editor for Energy and Commodities. Will, the action we saw yesterday by OPEC Plus was met really instantly by some objections from the United States, from the White House. Why should we be so surprised that there was cooperation between OPEC Plus countries and this is what they delivered? It seemed as if the US may be wrong-footed by this, but OPEC Plus as a grouping has existed for a long time, and Russia has been part of that.
Well, there was a lot of diplomatic outreach earlier in the year, just a few months ago, between President Biden and Crown Prince Mohammed bin Salman. As you remember, President Biden traveled to Saudi Arabia, and he sought more oil, and his political priority has been really to keep gasoline prices low. He's facing a difficult election in a month's time, and amid that, OPEC comes with a surprisingly large cut. I think if we were talking 10 days ago, no one would have said that they were going to cut quotas by 2 million barrels. They've done that because they see a lot of uncertainty in the market. Prices have been quite weak recently. But from a US perspective, it probably was quite a surprising move.
And is there anything they can do to counteract that, Will, realistically?
Well, the US has been intervening heavily in the oil market by releasing oil from the Strategic Petroleum Reserve. It's released almost half of what's available, so it could do more, but there are dangers there clearly in running down that stock of inventories too hard, so that will be one consideration. And they can look to encourage more oil production elsewhere. It was interesting that there was a report yesterday in the Wall Street Journal that they might ease sanction on Venezuela's oil industry, and of course the administration has been keen to have a deal with Iran.
Will, don't we have enough oil for us to use here in America, right under our own earth? Why would we, fly to Saudi Arabia courting Mohammed bin Salman and ease sanctions on Venezuela when we could just be nice to the people in like Texas, Oklahoma, and the Dakotas and get our own oil out of the ground?
Well, you don't have enough oil, frankly put, Matt. The US has a lot of oil, and oil production has increased markedly over the last decade, but it still imports huge amounts of oil, especially from Canada. That's not exactly how the oil market. Well, that,
Different countries.
you better tell Justin Trudeau that, because I think he might be a bit worried. But no, it is. The US does not have self-sufficiency, and it's a global oil market. Could the US try and keep more oil at home? Perhaps, but it doesn't. The oil is fungible, and the Middle East, the OPEC, Saudi Arabia remains absolutely critical to balancing the global oil market. It always has done, and it still does. And Saudi Arabia is really the only repository of spare oil capacity in the world. So whether President Biden likes it or not, Saudi Arabia remains an absolutely fundamental part of the global energy system.
Okay, and so we see calls now for oil likely going over $100 a barrel. Thank you very much, Will Kennedy, Bloomberg's Will Kennedy, with the latest on oil markets. And Canadians, fear not. Matt Miller, I am sure, was joking. And anyway, he's not
Just
in charge.
kidding.
So you have nothing to worry about. Coming up later today, more on the global oil market. We will talk to Stephen Schork, principal of the Schork Group. That's at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is ahead on this Thursday. The ECB will be publishing an account of its September policy meeting at 7:30 a.m. New York time. The European political community will be meeting for the first time in Prague. Plus, on the economic data front here in the U.S., we'll be getting initial jobless claims at 8:30 a.m. Eastern ahead of tomorrow's payrolls report. And we'll be hearing from more Fed speakers throughout the day, including Minneapolis Fed President Neil Kashkari, Chicago Fed President Charlie Evans, and Cleveland Fed President Loretta Mester. And Anna, I would imagine we'll hear something similar to what we've already heard from the likes of Mary Daly this week. They're going to keep going. They don't plan to cut in 2023.
Yeah, this Fed is not for pivoting, seems to be one way to summarize it. Now, let's think about how high the Fed goes with its rate hikes, shall we? Because we've heard over and over again about the concept of neutral rate R star, where the Fed needs to hike in order to balance supply and demand to rein in inflation. But Bloomberg's Valerie Teitel has been talking this week about another concept that's doing the rounds. I think a paper from the New York Fed put it out there that might complicate the Fed's inflation fight, and Valerie is here to talk us through it. So, Valerie, we've heard a lot then, R star, the neutral rate, where the Fed sort of weighs down on demand so that demand comes down to match supply, and lo and behold, inflation comes down. But R star is a little bit more complicated. Take us through it.
Yeah, so this paper went over this concept of R star, which is the level at which we reach financial instability. And the one conclusion from this paper is that after a time of low interest rates, when leverage is built up in the economy, similar to what we have today, that R star drops below R star. Meaning, as the Fed hikes rates, we hit a point where we hit financial instability problems before we begin to tackle inflation. And its argument was that the length of period of time where rates are kept low, this excess leverage built up, that this gap actually widens.
All right, so looking at this chart, I see a couple arrows for the past few hiking cycles. Is this one different? Is this cycle going to be different?
So look, there's a few reasons why this cycle is different. One is we have a more obvious urgency to hike rates to dampen inflation. We have an actual inflation problem. The second, if you look at it, maybe R star and R star before were closer. So 2008, the credit crisis, we saw cracks in the credit market. And then you look at the previous hiking cycle in 2015, where we saw cracks appear in the repo market. But maybe that was fine because R star and R star were close. So we didn't necessarily have this gap. Now, today, we have an actual inflation flight. We have an urgency to hike rates. And we could get to a point where the Fed needs to consider financial stability concerns before inflation turns around. And we always talk about this delay of transmission, like the transmission mechanism. You know, it'll be a few months before the rate hikes that the Fed has gone through to hit the real economy. But what if it's not just a delay? What if it's a completely different level where we see instability versus inflation declining?
Valerie, thank you very much. Bloomberg's Valerie Teitel joining us with the latest on this really interesting concept. And Kaylee, we've been talking about this a little bit this week. Valerie's been talking about this week, sort of behind the scenes and also on set with us, and also flagging how the Bank of England works into this, that this could be an interesting example where you see quantitative easing happening at the margin. They don't use that term. That's not what it's supposed to be. But we've got targeted policy action from the central bank at the same time as you've got interest rates going up.
Yeah, it's a question of what parallels exist there. And I would point out for everybody listening to us on radio, you can see that fantastic chart and the arrows that Valerie was talking about by checking out GTV Go on the Bloomberg terminal. That's where you'll see all of our charts that we use throughout the program.
That is it for Early Edition. More surveillance is ahead. The team will be Tom, John and Lisa, of course. They'll be hearing from a range of voices, including the Estonian Prime Minister, a gathering of European leaders happening in Prague today. This is Bloomberg.
what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
The market really has been held hostage by technicals, by sentiment, by politics, by geopolitics.
It's the uncertainty factor that's keeping markets on edge.
The markets have to go through the earnings season first, and I would expect that to be a volatile environment.
I think that there's a concern in the broader financial markets that something might happen within the U.S. markets.
We're very much looking out for that U.S. recession coming through because that's the key turning point for the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Next up, payrolls, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative 0.6%. Jobless claims a little bit later this morning. TK, then on to tomorrow for payrolls.
Yeah, something's changed this week, and it is, as we heard from Hollenhurst over at Citigroup, and many others as well. Tomorrow, all of a sudden, really matters for the Fed meeting. Going up, but far more than that, it has to confirm that jolt statistic from earlier this week. The jolt in the market is 2 good days, but then stasis, we really haven't pulled back.
And negative this morning, and some pushback from Fed speakers all over the place. Ramo yesterday, and I went through the Fed speak for today, and I just kept scrolling down.
I know.
It kept coming.
We're getting there.
And it kept coming.
Don't worry.
Who's not speaking today?
Exactly. Pretty much everyone, except for Fed Chair Jay Powell.
There
but
we go.
perhaps he's going to be the one that's going to be saying the same thing. And all of them are probably going to reiterate what Mary Daly said yesterday, which is stop thinking we're going to raise rates to a certain point and then we're going to just cut them. And they're basically continuing to push back against this idea of rate cuts in 2023. And the market keeps saying, you're wrong. I mean, basically, that's it.
That's what you want to signal. That's not what you're going to do.
Right, exactly.
It's basically the pushback.
Basically, people are getting more pessimistic on the global market, and they're saying the Fed's going to ultimately cave. And guess what? The market's been right. And this is sort of the perverse consequence of years of the Fed getting it wrong, the market being more correct. I mean, this is where the credibility question
That's the Fed speak. Let's talk about the controversy around OPEC Plus. Crude, the previous 3 days, Tom, up almost 11%
Yeah, in
the last 3 days.
I did a lot of technical studies this morning on this. I want to make clear, has not broken resistance, but boy, has it gotten there quickly.
Controversial.
Yeah.
It's in the pushback from the White House.
I was surprised. You were ahead of this on me. I was like, yeah, well, so what? Well, all of a sudden it's controversial, but it's only controversial about one thing. I think there's an election in November. That's all this is about.
It's Operation Midterms, without a doubt. The White House, Lisa, came out and said that OPEC Plus was aligning with Russia. Kind of stating the obvious because the clue's in the name. It's the plus in OPEC Plus.
And the Russian energy minister was there in person in Vienna. I mean, it's not that much of a stretch. But then that the response would be to release more from the Strategic Petroleum Reserve potentially into November. What convenient timing, to your point about what's going on with the election, raises some issues about stability in the market going forward if they've really used all of the reserves at a time when you aren't necessarily seeing the crisis level depletion of some of the of what's on stock.
Is that the best use of the SPR? Operation Midterms?
Are you really going to ask me for
I'm
my
asking
opinion?
that question. I'm going to
Just
ask
an
a
open
range.
question. Anyone else
I'm
like
going to
want
ask
to
a
comment?
range of people today that question.
Range across
You know, some people could say perhaps it gives stability to the economy in a time when you're laughing at me. I'm just trying to provide the other argument.
I'm just smiling.
Okay,
She doesn't
I'm
look
just
at me
saying.
because I'm always laughing.
Okay, but I'm just saying you could make an argument. However, a lot of people are concerned that at a time when you are seeing dwindling demand, they're going to use the SPR at a time when you've seen those reserves fall to record low levels.
We're very diplomatic in these show openings now. Very diplomatic.
It's because we're all closer together.
What do you think?
Agree.
Sensitive,
I agree.
you know.
It's sensitive and we're closer. I agree. It's all about that.
What's cool is we came into this new set, folks, and remember this, we brought the Bramo cam with us.
We did. We did. Futures right now, negative 0.7% on the S&P. I'm going to whip through the price action for you. Last couple of days before yesterday were really, really big. Then, as Tom pointed out, things have calmed down. Rolling over again, but we were deeply negative yesterday, and we took a big chunk out of that before we got to the close. Futures down about 25, call it 26 points lower, down 0.7%. Yields just a little bit higher by 2 basis points, 3.77. Euro dollar giving me nothing, 98.87, totally unchanged. And after all the drama of the previous 3 days, as we got that OPEC plus cut of about 2 million barrels a day, Lisa, crude going nowhere, $87.70.
And we can get into during the show exactly how much they're actually going to be cutting because they're not actually meeting the production targets as is. So it might be about a 1 million barrel cut and it might be a little bit less than that depending. So there's a lot of vagaries here as we see a meandering price action there. 7:30 a.m. we get the ECB monetary policy account. John, why is it called an account rather than minutes?
Because there's no detail whatsoever in them.
Okay, great. So
You don't get the sum, the several, a couple. They don't really go there.
Okay, so we're not going to get any detail, but people are going to be looking for it anyway, especially after the ECB speak that we heard yesterday. Christine Lagarde talking about several consecutive rate hikes in following meetings after there was a little bit of pushback from some of the doves on the ECB. Yesterday, German 10-year yields jumped by more than 16 basis points, the most going back to March 2020. Yes, this was the reversal of what we saw of a potential pivot over the first 2 days or the earlier days of the week because of Australia's central bank. I don't know, you can make your example, but other people speculating it has to do with the gas prices, natural gas prices in Europe. 8:30 a.m., U.S. initial jobless claims. How much does this give the tea leaves of a strong labor market, albeit with signs of slight weakening around the edges? Honestly, some of the projections that we've been hearing on Bloomberg surveillance are pretty dire in terms of how low unemployment claims would have to go before the Fed starts to either accelerate or how high some of the jobless rates have to go before they pull back. And these are some of the questions heading into tomorrow's non-farm payrolls. And today, this is for you. Fed speak includes, drumroll, Minneapolis Fed President Neil Kashkari, Chicago Fed President Charlie Evans, Fed Governor Lisa Cook, Fed Governor Chris Waller, Cleveland Fed President Loretta Mester, and anyone else on the Federal Reserve who wants to speak, they're welcome to come on this show, John. We'll make room for them.
You get Kashkari twice, and I think you get Mester twice as well.
Twice? Really? They're allowed to do that?
Twice in a day. Busy, hey?
I think the whole thing's ridiculous.
Is that enough for you?
We don't need to waste time on this. I've made it clear.
You think it's a waste of time?
I think it's way over communication. I think
President
it's just
Bostic
absolutely
President Bostic did a nice speech yesterday that's worthy of being read.
Okay, thank you.
So take a look at that. Vasilios Tronakis joins us now, the head of European FX strategy at Citi. Vasilios, I was going through your estimates for cable, for euro sterling. Cable, parity, below. Euro sterling, likely to get to about 95, maybe above. Vasilios, can you walk me through where that next leg of sterling weakness is going to come from?
Oh, it is coming very soon. Look, the market has been on a super high over the last few days, likely to a certain extent of broad-based dollar weakness because of the fact that there were quite a lot of short positions on there in equities, in bonds, and some longs in the dollar, and these are being pared back, and that's what we're seeing. It's a tactical rally. It's a bear market rally. It will soon come to an end, either through an exhaustion of positioning or through a catalyst, which could be the NFP tomorrow. But I think the big picture remains for being dollar bullish. Now, as far as sterling is concerned, look, I think what we've learned the recent days is that the UK government is still going ahead with that plan to boost growth, which is entirely unfounded empirically. No government has ever been able to target and achieve a certain level of growth, and apparently will be going ahead with increased borrowing. We haven't really heard anything to suggest that we're going to be in a massive U-turn. I hope that we will, but if that does not happen, I think the borrowing trajectory of the UK is going to be really bad, both for gilts as well as for sterling.
Vasilios, I looked at both today, the gilt, the 10-year gilt, and also sterling, as John mentioned, south. Which is the horse and which is the cart? Does FX follow fixed income, or does fixed income follow the currency market?
Well, I think typically what you're going to get is that the FX will be following yields, will be following the FX, the fixed income market. But I think when you are in situations where there is a crisis of confidence, because I think this is the environment that correctly describes what's happening in the UK, you get simply a confluence of factors that move things together. Effectively, what's happening is that you're getting the repricing higher of risk premium. And when this happens, you get both yields higher and the exchange rate lower. But from really a medium-term, deep fundamental perspective, the issue is going to be that sterling is going to remain the main shock absorber. You look back in, the previous year, in 1972, similar tax cuts in size, and eventually led to the chancellor floating the pound, and the pound lost about 38%. It acted as a shock absorber by then. Right now, you have even a bigger current account deficit. So I think it is unavoidable if these policies carry on and say that trajectory that we're going to see big depreciation in sterling.
What does the Bank of England do on October 14th?
That's a very good question. Look, I'm going to reverse it. I'm going to answer with a question. Does it really matter that much? Because if you see over the past 6 days, would have implied that they could have actually purchased up to 30 billion sterling in long-dated gilts. And they have actually purchased less than 4 billion. So effectively, yes, when we had the news, there was some headline impact and we saw a significant decline. But let me highlight the following. 30-year yield in the UK went from 5% all the way down to 3.8% on the announcement, 120 basis points. So far, they have recouped about 50 basis points of that, and they are trading close to 4.3%. So my bottom line is, yes, the BOV can do certain things. I think they were pretty explicit that they're going to terminate them on the 14th of October. But these things are only going to last in the very near term. The history is abundant by examples that unilateral central bank interventions, moves, actions cannot reverse when you have a big crisis of confidence.
Vasilios, thank you, sir. As always, Vasilios Giannakis there of Citi, working through some big issues in the European markets. Of course, we don't know what the counterfactual is, do we? Where would yields be if they weren't in the market, if they didn't have a package that size?
Correct. I mean, basically, he's saying it doesn't really matter, and it's going to weaken no matter what. But then does it mean that longer-term yields would be much higher? Does that mean... It's a very tricky issue, which is the reason why some people don't really know what's going to happen.
Do you want the phrase of the morning? Comes from Hyperconvexity, out on Twitter. Strategic midterm reserve. Do you like that?
I think that seems pretty accurate.
It's not the SPR, it's the Strategic Midterm Reserve.
It's the SMR.
We're going to have that conversation later. Dan Morris is going to join us too from BNP Paribas. Looking forward to that in the next hour. Futures down 0.7%, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The price of oil is holding steady a day after OPEC Plus agreed to the biggest production cut since 2020. And the alliance plans to slash daily output by 2 million barrels. And that move would drew a rebuke from the U.S., which has been seeking more oil from producers. Meanwhile, Russia repeated a warning that it won't sell any crude to any country that adopts a price cap. North Korea is ratcheting up tension in the region. It fired 2 suspected short-range ballistic missiles toward waters where the U.S. aircraft carrier Ronald Reagan had been deployed. Earlier this week, Kim Jong-un regime launched its first rocket over Japan in 5 years. North Korea criticized the U.S. for redeploying the Reagan carrier group to waters east of the peninsula.
In the UK, a new study says millions more Britons will be dragged into higher tax brackets over the next 3 years, and that will cost twice as much as Prime Minister Liz Truss's personal tax cuts. The report comes from the Institute for Fiscal Studies. The government is reducing the rate of income tax, but it's also freezing the threshold where people start paying, and that will force them into higher tax brackets. Atlanta Fed President Raphael Bostic says he favors lifting interest rates to as high as 4.5% this year. And then he wants to keep tightening in place to reduce inflation. Now, Bostic's view is in line with the Fed's policymakers. Markets are projecting the likelihood of a 75 basis point hike at the next meeting in November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September Jobs Report, Friday on Bloomberg Television and Radio.
The cut today came as a result of a collective assessment. In order for us to be attentive, we have to certainly be assertive, preemptive, and we have to be proactive. It could be a cut, it could be an increase, but it has to be.
Abdulaziz bin Salman, the Saudi energy minister. Fantastic job from Manus Crane and the team over in Vienna, Austria, covering OPEC Plus. Live from New York City this morning. Good morning. Futures negative 0.6% on the S&P 500. Here's the price action this morning in equities, bonds, and foreign exchange. Your bond market yields higher by a couple of basis points on a 10-year to 376.92. Euro dollar not doing much, 98.84. Crude has done a whole lot over the previous 3 days, up by almost 11%. I think it was on my screen. Crude, WTI, up by almost 11% over the previous 3 days. This morning, we're down by about 1/10% to $87.67. Getting some headlines, some comments from the Kremlin spokesperson, Dmitry Peskov, speaking on a conference call. Here's a taste of flavor of what he had to say. The output cut is aimed at stabilizing markets. The decision is not a sign of solidarity with any country. Then there's some pushback against the White House there. The price cap, Tom, on Russian oil is destructive and it hurts everybody. The comments from the Kremlin just moments ago.
Comments from the Kremlin, nothing on the war advance in Ukraine. I was stunned at the headline yesterday, John, of people beginning to pundit that Ukraine could go after Crimea from 2014, but certainly Russia deflecting the story, to say the least.
Clearly the price cap story that the Europeans are pushing has complicated the OPEC Plus effort in the last 24 hours.
Yeah.
And that's kind of blurred the lines, I think, for a lot of people.
Well, there it is, and it's an OPEC meeting. Is Manus still in Vienna? I think he still is.
I'm not sure he's
still
got the
working
plane yet, but I saw him there earlier this morning.
Yeah. Right now, we go to Anne-Marie Horton in Washington. She is focused on the election in OPEC Plus. Maria Tadeo is not, and she is in Prague this morning. Maria, away from the narrowness of the U.S. debate, moving out to the first Tuesday of November, what is the response to OPEC Plus across Brussels and continental Europe?
Well, Tom, the reality is oil is a conversation for the United States, and here there hasn't been much reaction because Europeans are focused on gas, as you know, and you're going to allow me to get technical, but yesterday the head of the European Commission, Ursula von der Leyen, sent out a letter to the 27 heads of states in which she said, we will intervene the gas market and prices need to go down. And what the Europeans are focused on is the gas price cap. That's their main focus, but this is an incredibly complicated situation because when you talk about a price cap, I can tell you there's at least 5 different formulas where that could work. And then, of course, you have the Germans who say they worry that any intervention would kill the little supply that's already in the market. So not a lot of reaction on the oil for them. This is very much a gas story today.
Anne-Marie, I want your response to all of this. Hyperconvexity out on Twitter, their phrase, not mine, but I'm going to use it all morning. The strategic midterm reserve, is that about to get tapped through the rest of this year?
Well, if you look at the statement closely from Jake Sullivan and Brian Deese yesterday, they said that this is something the president could do. He could once again tap the SPR. The issue with that, Jonathan, is at the moment, and we should note that already additional sales they have from that will be coming down the pipeline in the next few weeks, but we should note that the SPR right now, the levels they're at are the lowest they've been since the early 1980s, and there's a lot of pushback from the Republicans that the SPR has been politicized by this administration because it is not an emergency situation, it is not disaster relief, it is used to push prices down. And the White House also talks about the fact that they were able to get prices down from $5 in the peak in June to right now, they're going up a little bit, but just under $3.90 a gallon on the national average. So this is something we could see because this OPEC Plus decision has really put them in a bind because they still have to deal with the fact that gasoline prices, inflation are top of mind American voters. We should also note Americans are voting now in some states. Early voting is open. This is a big issue, and the timing and the optics of this was a huge snub for the White House.
Anne Marie, this is the reason why when you have the Kremlin saying that this is not political, people will say this is like a company saying we're not about to collapse. These are things that no one wants to ever say. And I'm curious from your perspective how much pushback there is to Saudi Arabia from the U.S. because of the snub, because the fist bump didn't work, the discussion didn't work. Now Russia's there. All of this kind of pushing against an agenda.
Yeah, it is. I mean, the timing of it is terrible in terms of the president just under 3 months from that fist bump, from his landmark trip to Saudi Arabia. And then, of course, this comes right before the midterm elections. But what I would say is that there has been U.S. officials, obviously, leading up to this, reaching out to their counterparts in the Gulf to advise them against this. But I think what is clear is that Saudi Arabia put the price of oil above their relationship with the United States with this decision.
Maria, I want to give you the final word on the path forward here. I hear much more from people that we've secured the energy we need to get through this winter, but in doing so, we've made 2023 incredibly fragile. Can you walk me through how people are talking about not just this winter, but next year as well?
Well, it is, because, Jonathan, when you look at storage, is 90%. And yesterday, one of my contacts actually told me that they expect to hit 100% of storage across the EU sooner than anticipated. So you could be looking at potentially in the next 2 to 3 weeks. So that is good for this year. But when it comes to next year, well, this is a complicated situation on the volume, especially if you do see that countries like Russia, we've had the Nord Stream explosions, Ukraine, whether that pipeline is going to hold or not is still a big question mark. And then you have the price. So this is going to be incredibly complicated going forward. But I think for a lot of European leaders, what they focus on, and remember, they also have their domestic agenda, is getting Europe through the winter.
Maria, Anne-Marie, unmatched, the two of you. Thank you. Maria Tadeo there and Anne-Marie Hordern. Elisa, Tom, this is where the conversation's at. TK, it goes beyond just this winter. It's what does next year look like? And if you've achieved the storage numbers you want to achieve for this winter, how do you repeat the act in 12 months' time?
And the gas-oil separation, where it's about gas in Europe, and over there, it's a very discrete conversation, as we started out with. In the U.S., it's about the election, and I'm told Nevada is one of the 2 key Senate elections now. In the last 30 days, a gallon of gas in Las Vegas from $4.82, John, to $5.54, and that's germane. That's a substantial jump.
We've looked at the chart. We were talking about that starting to go in the wrong direction.
Yeah.
Lisa, we've seen that in the last couple of days.
How much is this actually going to be something that will remedy that with more release from the Strategic Petroleum Reserve versus some of the frictions in the refineries? I mean, there's a lot of complications here in order to get even lower energy prices. And then here's the flip question. What happens if the output cut does not raise prices? What does that say about the global economy? And that's actually something that a lot of people were really wondering after some of these moves.
I go back to what Tom said, though, all year, and I think it's so important. What happens if China drops COVID zero, comes back online?
I'm all over it. I mean, I looked at Hong Kong flights yesterday. United Airlines announcing they're going to start up in January as well. Cathay Pacific still doing it, but boom, that opens up. 10 airlines, off we go.
That's the big change.
It's not there.
Live from New York City, futures lower. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City this morning. Good morning. The price action this Thursday morning shaping up as follows. We're down 0.7% on the S&P. Similar script to yesterday morning, and then we switched things around almost by the close. Futures down about 0.8% on the Nasdaq. 2s, 10s, and 30s shaping up as follows. Can we see some calm in the bond market for once? Some calm after Chris Harvey of Wells Fargo said govies are trading like cryptos. Yields are up by a couple of basis points on a 2-year 417, a couple of basis points higher on a 10-year 377. Crude has been absolutely surging over the previous three days. On the S&P 500, energy stocks are up more than 12% over the last 3 days. Over the same period, crude's up by around about 11%. Right now, crude just an inch lower, down 0.1%, 87.69. Brent crude, 93.28. We're down 0.1% there. A little bit later this morning, Tom, going to catch up with Francisco Blanch of Bank of America. Looking forward to doing so.
Really, that's really an important conversation. He's been very informative on this. And I have to point out, if we can get Ed Morse back on, who nailed $70 to $80, I wonder what he thinks right now. It's a great call. Here, right at the resistance level. This is a really important conversation with Pantheon Macroeconomics. Ian Shepherdson, always sharp on a global view distilled down to the Central Bank of the United States. Ian, you talk about the importance of Fed persistence here. If we get data that persists, this is a Fed that will blink. Walk us through how you perceive the data trail to be forward to where the Fed has to make a decision.
Yeah, so, well, December, I think, is shaping up to be potentially a very interesting meeting. So remember, the new Fed dot plot shows 125 basis points of hikes November, December together. And it looks to me that if we get more data that look like the JOLTS report that came out earlier this week showing a really big drop in job openings, and we also get a couple of decent CPI inflation reports, actually we get 3 before the December meeting, my guess is they're going to be much better than we saw last month. If that's the case, then I think the Fed's really going to struggle to convince markets that it needs to do a total 125 basis points in those last 2 meetings of the year. But let's be clear about this. We need both of these things to happen because the Fed's been very clear. A ton of speakers this week, and of course, Chair Powell at the last meeting at the press conference, saying, look, it's not just about the current inflation rate. And by the way, one good inflation number isn't going to do it. We need to see a run, fair enough. But it's also about the labor market, because what they're concerned about is that even though there's some pretty strong downward forces on inflation, there's this bullwhip effect in inventories is going to be quite a big deal over the next year or so. They're looking at wage growth of 5% plus and saying, look, even if inflation comes down quite rapidly by next spring, we're worried about where it will be later in 23 and 24 if wage growth doesn't moderate. So I do think they want to see some moderation in the labor market as well as some better inflation numbers. But here we are now with the possibility of that happening as soon as the end of this year. So this December meeting, I think, is going to be extremely interesting. I'm just wondering even whether in November the case for going by another 75 has already been weakened as well. You know, maybe that jobs number was a bolt from the blue. Nobody was expecting anything like that. You know, you get a 12% drop in job openings in 1 month. So some things are starting to move. The Fed speakers aren't moving yet, but, you know, a few more weeks of numbers like this, and there will be movement.
John, this is from November 2nd to December 14th, which is where Newcastle really decides the rest of their season.
You think that's the critical part?
That's a critical part of the track from November to
the Christmas
December
period
14th.
is usually the critical part of the season.
I'm becoming a sophisticate.
Ian, what you're saying about December now is what you said about September 3 months ago. What have you been surprised by?
Yeah. Well, what pushed them to the 75 September? You know, we had the horrible inflation numbers, and that made it impossible for them to do anything less than put the sledgehammer down again. But I think there's a very good chance that things change now. You know, we're seeing now so many retailers talking about how they've got far too much inventory. It's not just Walmart anymore. You know, Nike have said it, and we're hearing from the car business that inventory is rising again, and that's allowing sales to rise. But it's also seeing real downward pressure on prices. You know, used car prices are down 13% since January, and the rate of decline at auction is accelerating. So there's some things that I hope would happen by September that didn't are now happening, and they're in the data. But we need more of them. You know, just a snapshot of a few good numbers isn't going to be enough. I think Powell and his colleagues have been very clear about that. But the thing is, December's still a long way away. 3 more rounds of inflation reports, 3 more PPIs, 3 more CPIs, 2 more PCE reports. That's a lot of inflation data. And I think that we're kind of reaching this tipping point now where the bullwhip effect that all these companies are talking about is going to become visible in the hard data. And at that point, that puts the Fed into a different place, especially if at the same time, the next couple of jobs numbers are like anything like what we just saw this week. I mean, that really was very startling.
Ian, has Don't Fight the Fed turned into the Fed is just wrong and we're right? I mean, basically you're seeing the market say, we could hear from 15 more Fed speakers today and 25 tomorrow, and they could all tell us we're not going to cut rates next year. You're still going to cut rates because the data is moving faster than you're acknowledging. Do you think that the market is right and the Fed is wrong?
Well, they've both got a point. So here's the thing, you know, rates have gone up so much over the last year that under normal circumstances, I'd be screaming about a recession. I'd be screaming at the Fed, please, for goodness sake, stop all this hawkish talk, stop the tightening. You know, very soon you're going to have to signal an easing. The difference, the reason I'm not saying that so, you know, as I would be normally, is that the fact is that the household sector in the US is still sitting on $1.75 trillion of pandemic savings, which they are clearly being willing, this year anyway, to run down in order to maintain their spending. And that's offsetting some of the hit from interest rates. And similarly, in the corporate sector, there's a lot of cash as well. So, you know, again, in a normal economy with rates up this much, I'd say, yeah, you've definitely done enough, and you're in real danger of overdoing it, real danger of triggering a recession that we really don't need, I think. But the consumer's holding up extremely well, housing notwithstanding, and the corporate sector looks okay as well. But there's enough straws in the wind here now. You can see it in, for example, some of the regional Fed surveys. You know, capital spending intentions have really weakened a lot. You can see it obviously in the housing market, and you can see it in the JOLTS numbers, and you can see it in some of the other business surveys and the consumer surveys as well. Just saying that, you know, maybe things are beginning to wobble a bit in some sectors. It's not a collapse. It's not a rout of the economy. Definitely not. But is it the sort of economy where you still need to be hiking by 125 basis points at the next 2 meetings? That is far from clear to me at this point. What I'm really hoping is that by the time they sit down in December, it will be clear, and it'll be clear to them that they don't need to keep going so aggressively, because every incremental hike here now, I think, is raising the risk of triggering something that we don't need, because the U.S. economy, to me, doesn't need a recession.
Okay, triggering something that we don't need. The U.S. doesn't need a recession. Other people would disagree with that, including some people perhaps in the Federal Reserve, based on some of the forecasts that they have currently in play. What's your view, though, if we do get a recession, of the depth of it, based on the trajectory of rate hikes that we see, based on how quickly the data is changing to accept some of the weakness that people were expecting to see earlier in the year?
Yeah, so my general rule is that recessions are proportional to the imbalances in the private sector that preceded them. I mean, the whole point of recession is to force the private sector to change its behavior from doing, you know, things that are overstretching it to coming back to normal. So if it's not very overstretched, then it doesn't need a deep recession. So, you know, I don't expect anything like 08, be much more like 1990 or 2001, so mild and brief. But I don't think we need one at all, because I think this bullwhip effect in inventories and the crushing of margins that it's going to impose on the retail sector is going to bring inflation down faster than the Fed thinks, even without any meaningful rise in the unemployment rate. So now, I realize we've never seen anything like this before. We've never seen it on the upside with the speed of that margin expansion, and we've never seen anything on the potential downside that we've got coming either. This is very much uncharted territory. But, you know, when you're in uncharted territory and you've already hiked a lot, you know, maybe the prudent thing to do is to ease off a little bit and just have a look around. You know, that's the thing when it's uncharted. You don't know really where you are. So maybe pause, have a look around, give the data a couple of months to break one way or the other. If they don't, then okay, carry on hiking. But if they do break to the downside, bearing in mind monetary policy works with really quite long lags, if you're still hiking aggressively in November and December, and yet the inflation picture is already breaking to the downside, then what you've done is impose disinflationary forces on the economy for the whole of next year, which it probably doesn't need.
In the last 10 years, has the top 10 finished uncharted territory for Newcastle United, Ian?
Well, we're 7th now.
There we go.
Beat 17th.
Can I ask you guys a question? I've been whining for years as a complete amateur about more goals. Manchester City is doing that.
Haaland.
Are they changing the game?
Let's rephrase that. Haaland is doing that for Manchester.
But I mean, are they like the Boston Bruins with Bobby Orr? Are they changing the way the game's played?
I don't think they're changing the way the game's changed, Lisa. I think they've just gone and bought the most prolific scorer in world football right now.
Is that pretty much the most American thing that anyone should say?
He wants more points.
Basically, I want more goals, more action, because it's not active enough.
More points, not goals. More points.
More points, yes.
More points.
That's quintessential American response.
Goals.
More points.
Goals.
You should get
I'm
3
not wrong.
points for a goal. That's what you should do.
Should we do a road trip to Newcastle?
3 points for a goal.
With Dr. Shepardson?
Are you mocking us?
We should. I'm not mocking American sports. I love it.
That's a
Ball of
terrible idea.
basket?
It makes a ton of sense. Ian Shepardson and Tim
I mean, you go to the game at Newcastle, it's like when you go to see the Tots.
Hey, if you go to a game at Newcastle, that's a real atmosphere.
That's like old ball.
That is a real atmosphere.
Okay.
I'd love to go and watch a game up there. We should make that happen.
So do people there say, we'd like to see more points?
They'd like to see more points.
Yeah.
That's the conversation that Geordies have after every game in Newcastle.
But, you know,
We'd like
frankly,
more
to
points.
tie this into OPEC, John, aren't they taking, Newcastle's taken out by new owners?
True. Good point. The Saudis.
And what, is there a tension there?
There's a tension, I think, between them and the rest of the league at the moment about where the money's come from. But there's certain football clubs that have questionable sources.
I was
of
just trying to
revenue
make
as
this a legitimate business
sources of capital.
conversation and
Well, good effort. Do you want me to make this a legitimate conversation about
I
investing?
failed, but it was a good effort.
Can we pause for Mr. Platt over at Bluecrest and just go through his returns?
Wow.
I mean, seriously, 2016, 50% up. 17, 54, 18, 25, 19, 50%, 20, 95%, 21, 30%. And in 2022, that team apparently, reportedly, has put together gains of 114%.
And it comes after they closed their fund to a lot of outside investors because they wanted to be more aggressive and take more bold bets and not have to adhere to some of the standards of certain pensions, et cetera. And guess what? They've crushed it.
Can you think of how many different market regimes have played out in the last 6 years?
You think that Mike Wilson's on the team?
They've just crushed it. Those guys are, I don't know, just next level. Next level.
John, I've actually looked at this very hard. To get beyond year 3 is statistically brutal.
It's on 114% in 2022.
Well, that doesn't surprise me, but as you say, with that sequence of excellence.
Come on, it's
like I reject this.
No, it's just it's incredible.
It is incredible.
It's incredible. Credit to them. Futures down 0.7 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, it looks like President Biden's fist bump with Saudi Arabia's Crown Prince Mohammed bin Salman and less than 3 months ago didn't pay off. Instead, the Saudis snubbed the president and aided Vladimir Putin with that OPEC plus oil production cut. President Biden had hoped his visit to Saudi Arabia would encourage the Saudis to pump more oil. Shares of Shell dropped after the energy giant pointed to a weaker third quarter performance, and that's likely to end a run of record earnings. Shell's refining and chemicals business showed signs of a slowdown, and that could be a worrying sign for Europe, where major industries are buckling under the pressure of soaring natural gas prices. Global foreign currency reserves are falling at the fastest pace on record. Reserves have dropped by about $1 trillion this year, about 7.8%. Now, part of the slump is due to valuation changes, but the stresses in the market are forcing a number of central banks to intervene to support their currencies. In the UK, at least $340 billion was wiped out from the nation's stock and bond markets in the first month of Liz Truss's government. The September sell-off on concerns about tax cuts saw the pound hit a record low, a Bank of England intervention, and eventually a government U-turn. And one strategist says investors tell him the UK market is uninvestable. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. A $7 trillion industry. A lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
I see us as raising to a level that we
believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
The brilliant Mike McKee sitting down with Mary Daly, the San Francisco Fed president, yesterday. Live from New York City this morning. Good morning to you all. Your market shaping up as follows on the S&P. Deeply negative yesterday. Negative again this morning, just like we were yesterday morning. Then we erased much of that by the close yesterday. Futures down by about 0.7%. Yields higher by a couple of basis points. The US 10-year 377, euro dollar unchanged at 98.83. And after the surge in crude over the last 3 days, 87.23 this morning on WTI, we are down negative by 0.6%. Just getting some headlines out of Sweden on the damage done to Nord Stream. Just going to go through a few of them for you. The security service says Nord Stream damage is from detonation. The gas leak crime scene probe has been concluded. Suspicions of sabotage have strengthened. The probe, Tom, showing signs of detonations. The latest from the Swedish security service this morning.
And I guess we see more. I mean, I don't know how deep it is, but it's not that deep to begin with. And they go down with cameras, right?
As we get more headlines, I'll share them with you, Tom.
I think that's all there is to it. Futures negative 27. The VIX remarkably stable over the last number of days, which has been noted by those looking for a cathartic move. It hasn't happened. Right now, Julie Norman joins us. We're going to right the ship here on a lot of the discussion of the war in Ukraine. She's co-director of the UCL Center on U.S. Politics and is noted for a real understanding of war and terror. Professor Norman, good morning. It's been a topic on this show, and frankly, I think it's out in the zeitgeist as well. The response that any institution should have to what happens in a war, never pretty, but then there's torture. How do you judge or gauge the reports we see from Ukraine of heinous acts?
Oh, well, Tom, we've seen reports of heinous acts from Ukraine really since the very beginning, and I don't think we should sugarcoat that at all. Obviously, it's hard to verify all information, all stories that are coming out in a conflict situation, but we have seen just so many patterns from Russia's atrocities in this war in different parts of Ukraine, and it matches a lot of their tactics that they've used in previous conflicts as well. So this is part of a pattern for Russia, and it's one that I unfortunately expect that we will continue to see more of as the war continues. Even today, we saw targeting of civilians, which is a bit different than some other atrocities we've been focusing on, but that will continue.
Whatever anyone's politics, in the movies, there's the Geneva Convention. What convention is there now? How do we institutionally respond to this?
Yeah, well, we always have these international law documents. We have a Convention Against Torture, which has a lot of sign-on to it, but all of those are only as strong as the will to enforce them is.